think this kind of AI CapEx cycle still has room here.
Right now, you got to be bullish.
How many articles are you going to read about a bubble in AI and not start to be a little bit worried?
A lot of the speculative fervor has been outside the mega cap tech areas within the market.
I do think we're overlooking some of the flags that have been waving.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday within 1% of all-time highs, President Trump teasing the prospect of a good deal with China as earnings from the financials help to calm credit market fears. Anthropic and Google in talks on a multi-billion-dollar cloud deal. That stock inching high this morning.
What this really highlights is just how interconnected the AI story has become. You have companies that invest in other companies that then make deals with those companies that also are connected to other companies. So Google and Anthropic have an investment partnership. Now you have an interconnected relationship between the two of them. And guess what? Amazon is also an investor in Anthropic. Again, this question of how self-referential is this AI story becoming?
Alphabet in the pre-market high by 1.4%. Those earnings from that company about a week away. We've had earnings from one company in particular I want to talk about, Mattel. Mattel's getting absolutely hammered. Let's talk about the price of uncertainty. That might be an asset going into negotiations with China. It's not in corporate America. Retailers are holding back.
Retailers are holding back, and they are struggling right now when it comes to how they are dealing with the supply orders from other retailers now being all pushed into the fourth quarter because people are realizing they're going to need to have toys on the shelves when it comes to Christmas. When they talk about tariffs, this is what the CEO had to say. I would say it's all about that, and that this year is unusual. They are suffering at the hands of sky-high tariffs, and they are even pushing the prices onto consumers, but they say consumers are still buying.
Mattel down 6%. That disruption starting to come to the surface.
Yeah, and they're saying that people didn't order as many toys for Christmas because of the potential increases or delays coming from China. It just highlights what difficulty it is for specific sector, because you've seen other places really adapt and adjust just fine. The toy business is so heavily dependent on China. Where are your Barbies made? China. Where are your hot rods made? In China. And so it shows how there are pockets of disruption that still haven't come fully to the fore. And when you see those, they are punished.
Let's talk about pockets of stress, pockets of credit stress, because elsewhere, solid earnings, Western Alliance, Capital One. If you expected to see some real credit issues, broad-based, systemic problems, you'd expect it to show up in the banks. You'd expect to see it in the credit card companies.
Yeah, so Capital One came out with blockbuster earnings on the heel of their Discovery tie-up. When it comes to Western Alliance, this is the company that always gets beaten up, right? It's the bank that always has the malfeasance, and they did have higher than expected credit charges and write-offs because of some of the fraud that they were talking about, but still, bang up earnings. So can you really look at that as your expectation of weakness, as your expectation of anxiety? People are kind of fading on that.
Those names trading firmer after the close. Two to watch going into the open. Equity futures so far this morning positive by around about 0.1%. Coming up this hour, we'll catch up with Max Kettner of HSBC with stocks sitting near all-time highs. Ed Mills of Raymond James with US-China trade talks in question. And Jason Bazinet of Citi on the mixed results from Netflix. We begin this hour with stocks holding steady with more earnings on deck. Max Kettner of HSBC writing further likely strength in US equities should be enough to prompt a broader risk-on move. Max joins us now for more. Max, good morning, sir. You've talked a lot about how the bar for growth is low enough that we can deliver some upside surprises. Can you say the same thing about earnings into next week with big tech on deck?
Yeah, good morning. Thanks for having me. Look, I do think so. I think actually the bar, when we look at X-Tech, for example, is extremely low. Look at when we headed into the earnings season, you guys were just talking about banks and about the financials. We had a sort of minus 4% quarter-over-quarter earnings growth expected from consensus. So when you exclude tech, actually consensus was saying that earnings are going to go down sequentially. And bear in mind, that's a nominal number. Whereas, all the top-down GDP proxies, GDP now, all of the stuff was trending around 3 to 4% for Q3 in real terms. So we're sort of talking maybe 6% nominal GDP growth. And consensus is saying earnings are going to go down. That really means there is a genuine risk that actually the earnings beat rate, not just in tech, but in the broader market, the earnings beat rate will be even better than in the second quarter. And that would then be the biggest earnings beat rate since COVID. So for all those people who are like, we're all just firing on one cylinder, it's just tech. No, it's not just tech. In fact, we are seeing broad-based and underestimated strength elsewhere as well.
Certainly saw that with the banks last week on Wall Street. Max, we are seeing, though, pockets of stress, pockets of credit stress, pockets of disruption. We saw that with Mattel. We saw that with some of the issues over the past month with First Brands, with Tricolor. Max, what's your approach now? You've been bullish through most of this year, through a lot of volatility. Is it still a market cap index, or are you going to be a little bit more nuanced into year end?
No, look, I think it is a market where you have to be more nuanced. When you look at the consumer side of things, for example, probably most of the discretionary stuff is fine, but when you look at the consumer staple stuff, the consumer good stuff, most of that is imported. Most of those companies, there's a lot of companies that are struggling, that really are seeing costs rising and that are struggling to pass on those higher costs. So on the consumer staple side, I'd really be cautious. But when we look at the banks, when we look at particularly things like industrials, for example, I do think actually that is still an area where I would focus on. Aside from tech for me still remains that core holding, because I do think heading into 2026, what people are underestimating really is the ability through the One Big Beautiful Bill, the ability to expense CapEx straight away. That does apply then to AI CapEx as well. And that, of course, means that any kind of AI CapEx that you plan for perhaps the next 2-3 years, you've got every incentive to pull that CapEx forward. And that should mean that those CapEx expectations on the AI, on the hyperscaler side, perhaps are still too conservative for 2026. And that heading into the earnings season for tech companies is another potential upside catalyst.
So how much, Max, do you look at this and say, I don't care about the circularity of this? The idea that Amazon and Alphabet are increasingly hedged to Anthropic. OpenAI is absolutely central to every single company because they seem to be making deals with everyone. The fact that they're all interconnected, one bad report could send the whole sector down. You just dismiss that as sort of not feasible given the likely investment trajectory. Is that right?
Yeah, I might be oversimplifying things here, but when I read this the first time a couple of weeks ago with the OpenAI with the 100 billion investment, I thought to myself, I read the story twice, and I thought to myself, isn't that just normal B2B? Would we look at sort of, let's say Walmart, Target, some of the grocers, they've got their suppliers. The suppliers then are invested in other suppliers. That they're getting their supplies from the other suppliers and all this sort of stuff. So I'm not really particularly convinced about that. To me, that sounds just like an ecosystem, a fairly closed ecosystem. But of course, you're not going to go, let's use the grocers. You're not going to go, NVIDIA or OpenAI is not going to go to Walmart and like, oh yeah, you know what, we need 100 billion of sandwiches. No, we're not going to get that yet. So I don't think it's a particularly spectacularly bearish thing or dangerous thing that it is a fairly closed ecosystem and they're sort of feeding off each other. That's just normal B2B, I would say. Is there a risk for AI CapEx, for the AI the hyperscalers? Yes, I do think so, but I think not in the next 6 to 12 months. The next 6 to 12 months, again, with that ability to expense CapEx straight away, that actually introduces even more upside risk on the CapEx side. The risk, I think, then comes maybe into 2027, that maybe we've seen so much CapEx pulled forward, that then actually the delta going into 2027 in terms of AI CapEx might not even be lower, but it actually might be turning negative. But that, of course, that is minimum 6, if not even 12 months too early to play.
How much is the ongoing rally that we've seen really bolstered by what we've seen in the bond market? We've seen 10-year yields in the U.S. fall to the lowest levels going back to October of 2024. On this expectation that the Fed will cut, on this expectation that the economy is softening, how much is that underpinning your optimism and the optimism in markets?
Yeah, it depends. I think it depends when you look at, obviously, stuff like non-profitable tech, when you look at stuff like small caps, that very much, I think, is underpinned by the idea that we're not heading quite into a recession, that growth overall is actually fine, but there are these pockets of weakness, there are these pockets of labor market weakness and labor market cracks, and that renders rate cuts justified. And that, of course, then spurs strength in some of the, let's say, some of the more niche kind of corners of the market. The overall market, I think it's not really underpinning a lot of our opinion because, let's face it, we've got a terminal rate price then of around 285 for the beginning of 2027. If we were to move, let's say, if we were to cut a price one cut out from 285 to 310, that is barely above the long run dot. If that is then coming because of better growth, perhaps because of better payrolls or better earnings, if that is a result of better fundamentals, that is still a very, very dovish number where the market thinks we eventually end up. And the higher number is driven by better growth. So it much more then is a case of, well, we need to rotate perhaps away from the Russell, from non-profitable tech, more towards large cap cyclicals. But it's not really something that's underpinning our view overall.
Max, do you need to rethink the whole AI trade at some point when these robots and the whole AI industry starts taking jobs? A report yesterday in the New York Times that Amazon plans to replace more than 500,000 jobs with robots. Isn't that going to impact growth and the macroeconomics of the United States?
Yeah, look, I mean, there are two things that I want to say. The first one is, I think people are at the moment looking at AI only as a bearish thing. The first one, of course, is, which I'm sure you guys have talked about at length, is AI is a bubble. It's just like 2000. So you kind of have to go through, well, actually, look at Amazon. You just mentioned Amazon. AWS makes more revenue in the last 12 months than 468 other companies in the S&P. So it is not like 2000. They are printing hard cash as if there is no tomorrow. That's number one. Number two is, I feel like with AI, there is, mostly for bearish people, there's this narrative that basically either return on investment assumptions are way too rosy, that's never going to be fulfilled, so therefore AI is bound to disappoint, or if those return on investment assumptions are fulfilled, if the productivity gains come, well, then AI is going to come for your jobs, and then it's also bad. So I'm kind of sit there, I'm like, oh, great, so we're all buying AI and tech stocks, but actually the whole market is wrong because whatever happens, it's going to be bad. I'm not really sold on that. And the third thing on that is, when we look at job cuts so far, again, the narrative is, well, AI is already coming for your job. Look at job cuts. Look at challenger job cuts. If you look at job cuts by reason, actually, there is barely more than 1% of job cuts year to date that are due to AI. Last year, it was also about 1.1%. So in fact, you've got about 99% of job cuts at the moment because of different reasons than AI. So I feel the narrative doesn't really stack up with the data at the moment, at least.
But Max, there is something to all this. I think we should discuss it, at least so far this year. If I told someone all the payrolls data for the year ahead at the start of the year, they would have been hopelessly bearish for 2025 and would have missed out a massive rally. And Max, I think that raises the question just how relevant jobs data is to the broader equity market at the moment and whether that dichotomy can persist into 26.
Yeah, I think that's a very good point, because going into next year, bear in mind, yes, if you had told someone the payroll data, they probably would have freaked out, right, in hindsight. But if you had told them the payroll numbers and on top of that, then the break-even payroll numbers, how the break-even payroll numbers have gone from almost 250,000 just about 2.5 years ago to pretty much probably zero by the end of this year, then, that puts lower payroll numbers very much into perspective. So we've got to be careful about that. Where I do think there is some danger, really, particularly in the first half of the year. What happens if we get a sort of a 40, 50K number on payroll? So nothing really spectacular. In fact, just like you said, a number that, 6-9 months ago would have made us freak out. If we do get that, but actually the break-even payroll number is already close to zero, that might be enough to not just keep the unemployment rate stable, but in fact make the unemployment rate decline. And that, to me, is a real hawkish risk. That is a risk to all the steepeners that people have on, because it would see really the front end bear flatten it. It's a risk to the EM trade. It's a risk to the short dollar trade. It's a lot of that really is one of the key risks, I think, for the first half. Not for the next 3 months, because we have seen one factor go up and all this. The next 3 months, still a bit more weakness. But I think for the first half, that is certainly a risk to watch.
That would send heads spinning, that's for sure, Max. Thank you, sir. Max Kettner of HSBC. Need some jobs data first. That'd be nice. Gone a few months without it already.
Which is the reason why things like the Philadelphia manufacturing yesterday sent the market into a tailspin, because we don't have anything else. It's true. We're talking about these big picture shifts, trying to look into the dark that suddenly is even darker. And this is the really difficulty right now. Do you just ignore it? Because a lot of people are just ignoring it and bidding prices up on stocks. And that sort of is the conclusion in markets.
Paid to ignore it, at least so far. That can change quickly. Equity futures on the S&P positive by 0.1%. With an update on stories worldwide with your Bloomberg brief, let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. President Donald Trump says the upcoming meeting with Chinese President Xi would yield a good deal on trade. Still, Trump said the possibility remains that the meeting could fail to materialize. Treasury Secretary Scott Bessent is expected to meet with his Chinese counterparts to discuss a de-escalation of trade tensions later this week ahead of the Trump-Xi talks. Meanwhile, peace talks between Russia and Ukraine are showing signs of stalling. after White House sources said there are no plans for a meeting between President Trump and President Putin. The leaders had been scheduled to meet in Budapest within the coming weeks. The Kremlin on Tuesday maintained that Russia is sticking to its original demands, including Ukraine cede full control of the Donetsk region. And Netflix shares falling 6% in the pre-market after the company reported third quarter earnings that were hurt by a tax dispute with Brazil. The company had to pay over $600 million to settle a multi-year tax dispute, but said it would have beaten forecasts if not for the expense. Netflix's outlook for the current quarter is largely in line with Wall Street estimates. That's your Bloomberg Brief. John?
Yahira, thank you. And that appears to be the disappointment there. The outlook in line. The stock is down by about 6%. Up next on the program, President Trump looking for leverage.
Right now, as of November 1st, China will have about 155% tariff put on it. And I don't think it's sustainable for them.
So either it's going to be a good deal or 155% tariffs. Ed Mills of Raymond James joins us next, live from New York City this morning. Good morning. Three days, no losses on the S&P 500, within 1% of all-time highs. Futures up this morning by 0.1%. Under surveillance this morning, President Trump looking for leverage.
Right now, as of November 1st, China will have about 155% tariff put on it. And I don't think it's sustainable for them, so I want to be nice to China. But China's been very rough with us over the years because we had presidents that weren't smart from a business standpoint. Some were good politicians, some weren't even good politicians, but they allowed China to take advantage of us and every other country.
So here's the latest this morning. Trade tensions between the United States and China remaining high. President Trump saying he expects to reach a good trade deal with China, but his meeting with President Xi Jinping in South Korea next week may not happen. Tyler Kendall joins us now for more. Good morning, Tyler. So I think all of our heads are spinning here. Is this meeting happening or not?
Yeah. Hey, John. Good morning. Well, President Trump cautioned that the highly anticipated meeting with Chinese President Xi Jinping could still fall apart. Now, to be sure, the White House has not confirmed a specific date or time for the potential meeting. But as you mentioned, it is widely expected to take place on the sidelines of the APEC summit in South Korea next week. Now, one meeting that we are banking on happening is that the Treasury Secretary Scott Bessent is set to meet face-to-face with his Chinese counterparts in Malaysia over the weekend. That is widely seen as the precursor and could give us some clues heading into next week and whether or not President Trump does sit down with Xi Jinping. Now, if the leaders do meet, our analysts at Bloomberg Economics say their base case here is that we're likely looking at another 30-day extension to the trade truce set to expire on November 10th instead of a tangible deal. Now, that doesn't mean that we wouldn't get some sort of update or movement when it comes to the top friction points. Of course, we're watching closely what happens with export controls, whether or not there's a loosening from either side, and also, of course, U.S. agricultural purchases, whether China makes any sort of commitments as soybean farmers are set to receive a round of economic assistance later this week. But that's really just the tip of the spear here. Of course, there are a lot of different issues on the table, everything from investment to potential Boeing purchases, fentanyl, Taiwan, even TikTok. And of course, President Trump's threat looming over all of this that there could be a 155% tariff if he's unhappy with the deal. Now, John, despite the tariffs in place and the threat of more tariffs, new data is showing us that China's export market to the U.S. is proving resilient, at least in the short term. Exports to the U.S. are down 17% this year, but firms still report spending more than $317 billion worth of goods to the U.S. through the third quarter.
Tyler Kendall with the latest. Tyler, thank you. Down in Washington, D.C., Ed Mills of Raymond James writes the following. The big question is how much beyond the status quo can get negotiated? And is previously banned U.S. technology about to get the green light for the Chinese market? Ed joins us now for more. Ed, I think you're right on the money. What is and isn't on the table in these negotiations? What is and isn't going to be part of any potential deal?
Yeah, John, I think everything is on the table. I think what we're seeing is that if China went into this with the status quo, China would come out with the status quo. So you're seeing a playbook we've seen time and time again. And Trump is moving the goalpost, ramping up the pressure. Xi is doing the same. Xi in China has come to Trump 2.0 much more prepared. They are sending a message. We're willing to do things that could be mutually assured economic destruction. So come to the table and talk. I do think the number one thing that Xi cares about in these conversations are these tech controls, the semiconductors and semicap equipment that has been banned going into China. The U.S. policy is shifting here, John, and it is now the default kind of desire of the U.S. government to have the U.S. technology be the default full stack globally, and they don't think they can kind of shut out the Chinese market. So there's more room for negotiation here than I think most investors realize.
Ed, is China basically taking this hardline strategy? And there's been some reporting about this because they think Trump will fold.
I think it's they think Trump will fold, or they will think that Trump will give them more if they push for more. Annmarie, you go back to earlier this year, it was their restrictions on rare earths that got Trump to walk back those 145% tariffs. We were dangerously close to having real negative impact on our industrial production here in the United States. And while we're signing these different critical mineral deals, rare earth deals, it's going to be 5+ years before we're able to get most of these. So China does have some cards that they can play. And as they play them, Trump has been willing to negotiate more. They view Trump as a transactor. And so to get him to transact, you got to push him in that right direction.
Do you find it suspect that China hasn't confirmed any meeting?
It's been the way things have happened all year long. What we have seen is the U.S. delegation comes out and they give a readout, and then China confirms nothing. And then what we've seen is that everything that the U.S. side has said has actually followed through. I do think this meeting happens. I do think part of this is that she does not want to appear to be weak. Some of the calculus that China has had is that what Trump wanted the most was to have this meeting. So they gave him a meeting. I'm also okay with the fact that we've already set up a home and away after this. Trump is supposed to go to Beijing. She is supposed to come to the United States. So that takes away a little bit of the pressure here. That hasn't been confirmed necessarily by the Chinese side either. But we can get some flourish, big announcements coming out, but really working on these details to be determined later on, which has happened on every other trade deal so far this year.
And it seems like they're both buying time, both the Chinese and the United States, in trying to rearrange some of the supply chains and the technological backdrop in the meantime. I just wonder what the negotiating chips are going to be to buy time, how much Taiwan's going to come into play, how much the Russia-Ukraine war is going to come into play. Do you have a sense of how much that's on the table if there is some sort of meeting?
Yeah, so Trump has said that he expects there to be some level of conversation about Taiwan. I do think that this is obviously the big focus of a lot of investors, and I get a ton of questions about that at Raymond James. Trump has said that they don't have a plan to invade. I think trying to bring down a little bit of those tensions. The last meeting between a U.S. president and Xi occurred at the last APEC summit, and Xi supportedly said that there was no kind of need for a military intervention as long as a peaceful reunification occurs. I do think that a lot of folks look at that Trump as a transactor to say, is Taiwan more on the table than we could normally see? Beyond that, Trump has also been very concerned about the agricultural purchases of China. So can China make some kind of agricultural purchases, make that commitment for $1 trillion of investment in the United States, and therefore we can send them those semiconductors and that semicap equipment, especially if we're moving to this idea that U.S. technology needs to be the default technology. Those are the things that I'm watching here in these negotiations, Lisa.
Ed, appreciate your time. Ed Mills of Raymond James. I think we also have to tackle the underlying premise here as well, the sustainability of the current tariffs. China's on course to run a record trade surplus in 2025, even with these tariffs.
And it's largely because of exports to the rest of the world. But even in the United States, you see, yes, exports to the U.S. from China are down 17%. They're still at the same levels as 2020. They're higher than 2017 and 2016. So you start looking at what we're actually seeing. It is not a decoupling by any means.
Equity futures so far this morning positive by about 0.1%, around 0.25%, away from record highs that are closed just yesterday. Up next on the programme, we'll catch up with Stephen Cook of the Council on Foreign Relations with a fragile ceasefire holding in the Middle East. Plus, Danny has your morning movers. Google jumping on news of a massive cloud deal. Equity futures on the S&P very close to all-time highs. We're positive by around about 1/10%. The equity picture looks a little something like this. The Nasdaq 100 down by not even 1/10. We'll talk about Netflix in just a moment. In the bond market, 2s, 10s, 30s, waiting patiently for inflation data on Friday, and seemingly everyone's preparing to ignore it because this Federal Reserve is on course to cut interest rates a week today. Your 2-year bond yield at 3.4487, and maybe the Bank of England might join the party. 4 days of sterling weakness. The UK delivering inflation data a little bit earlier on this morning. Guess when that dropped? You can see it on the chart. 133 on cable. Inflation in the UK coming in softer than expected. That currency pair down this morning by 0.5%. That's the cross-asset picture this morning in the market. Let's get you some single names, some morning movers. Let's cross over to Danny for more. Hey, Danny.
John, you promised Netflix. Let's start there. Dragging the overall index down. Shares down 6.2%. A couple problems here. One, they cited a tax dispute with Brazil that's going to cost them over $600 million. To be fair, they said that won't extend into the future. So why are we down 6%? Maybe expectations were just higher for Netflix. They mostly reported in line, slight beats in some areas, but investors were expecting more with shows like K-pop Demon Hunter, movies rather, that seemingly would have boosted them even more. So a tough morning for Netflix in the pre-market. Also, in terms of disappointing earnings, there was Texas Instruments. Those shares down nearly 8%. It was a lackluster forecast. Does it mean that the chip industry, the outlook for their analog chips is sputtering? The CEO talked about on the call the fact that industrial clients are in wait-and-see mode because of government policy around tariffs. So that's really pressuring them. Tech that is doing well today. Google certainly up there. Bloomberg sources saying that they are in talks to ink a deal with Anthropic to give Anthropic access to more cloud computing power, and Google's own specific chip shares are up 2%. Should also be noted that Google is already an investor in Anthropic, as is Amazon. John.
Danny, thank you. We'll come back to that story in just a moment. On our radar this morning, President Donald Trump saying tariffs on Chinese goods could rise to 155% next month if no trade deal is reached. President Trump adding a meeting with Chinese leader Xi Jinping slated for next week may not happen. Elsewhere, regional banks provided more relief over credit concerns. Western Alliance posting a double earnings beat for the third quarter. Capital One reporting an 80% surge in net income while announcing a $16 billion stock buyback. And finally, to build on the story that Danny mentioned, AI startup Anthropic looking to strike a multi-billion-dollar deal with Google. Sources telling us here at Bloomberg that Google will provide cloud computing services to Anthropic to accelerate machine learning. Both sides declining to comment.
And this raises a question about, again, the sort of circularity of some of the industry. And going back to what Max Kettner was saying, look, you don't expect them to go to Walmart to buy sandwiches. They're going to go to each other to buy the equipment that they need. At the same time, if you do hinge a lot of the valuations on the need for computing power that currently is the case, how vulnerable are we to another DeepSeek moment? DeepSeek seems so far away, but what if there is more efficiency? What if there is a new technology and all of a sudden you have all of this investment in very specific labor-intensive, energy-intensive endeavors? These are some of the questions that people have, but they're looking past it because so far it's been a bonanza.
Well, we moved past that shock pretty quickly and got back to spend. Alphabet, by the way, whipsawed in the last 24 hours. Yesterday got hammered. Some real worries about OpenAI and a new search engine being a direct competitor to that company. That's the existential risk that some of these companies at the moment are confronting.
It's hard to imagine this, but OpenAI and ChatGPT only came to the fore in 2022. It launched this incredible rush toward the idea of artificial intelligence and machine learning in a way that has been absolutely transformational, at least in the stock market. And it raises a question, is there someone else who could come in and do the same thing, especially given how competitive the field is getting?
Alphabet bouncing back. That stock is higher by about 2%. Let's turn to politics and regional politics. In the Middle East, Vice President J.D. Vance meeting the Israeli Prime Minister in Jerusalem after saying he remains optimistic about the future of a ceasefire between Israel and Hamas. Joining us now from Tel Aviv is Bloomberg's Ethan Broner. Ethan, welcome to the program and thanks for making some time for us. How hopeful are people in the region? How fragile is this truce?
Well, it's very fragile. What's interesting is how invested the Trump administration is in holding on to it and making it work. So, as you said, the vice president has been here. He's just finished his meeting with Prime Minister Netanyahu. Earlier, we had Jared Kushner, Trump's son-in-law, and Steve Witkoff as special envoy. And later this week, we expect Secretary of State Marco Rubio to come. So this is a surprising parade of very senior U.S. officials who are basically babysitting this thing, trying to make sure that the Israelis don't overstep in retaliating against Hamas, and also sending a message to Hamas and the region that this is not a one-off, that they're very serious about it. Will that be enough? We don't know.
Ethan, do you and the team get the sense that regional partners are equally as invested as the United States in maintaining this truce?
Difficult to tell. I think that we have the Crown Prince of Saudi Arabia is going to Washington to see the president quite soon. That's a very interesting development. We know that the Emiratis are very interested. We know that Qatar is interested. You know, as invested, it's hard to say, but invested, and certainly via their links with the president and his sons and all of their business interests playing a role as well. So I do think that the president has done a pretty good job of getting everybody focused on it. It's just we're looking at, Hamas is a pretty complicated and unpredictable organization, and Israel has been traumatized for 2 years. So these two players are difficult to predict.
We're in a period of intense diplomacy and it continues. Ethan, thanks for jumping on. Thank you, sir. Ethan Broner there of Bloomberg. Stephen Cook of the Council on Foreign Relations joins us now for more. Stephen, good morning.
Good morning.
You've described this as continuous diplomacy. What's the importance of that in a moment like this?
Well, look, the president, the Secretary of State, the Vice President, Steve Witkoff, everybody is there continuously to hold the Israelis' feet to the fire on this. President Biden tried this, but Prime Minister Netanyahu just wasn't afraid of Secretary of State Tony Blinken at the time. Well, he's afraid of Donald Trump, and Donald Trump is insistent that this 20-point plan get implemented, and the way to do it is to keep sending senior American officials speaking on behalf of the President of the United States to ensure that Netanyahu and his coalition partners don't wiggle out of this thing.
But on that point, isn't it because of how the president has spoken to Bibi behind the scenes in a way that Biden would never?
Oh, absolutely. I mean, I think there's some benefit here to the fact that President Trump is purely transactional and doesn't have the kind of ideological commitment to Israel that President Biden had. So when he says everybody's going to be treated fairly, you're going to give me and I'm going to do for you, that's really important because Netanyahu hasn't been treated like that by any president before. And I think he's concerned that if he crosses President Trump, which he has done and paid for it, the Qatar strike was one of them, but that Qatar strike actually helped get to the point where we are. But if he crosses President Trump, there'll be consequences for Israel.
Who is running the Gaza Strip right now?
The IDF is running the Gaza Strip right now, and there are atomized groups of Hamas terrorists who are also running the Gaza Strip. We've seen terrible video of Hamas taking it out on its opponents in the Gaza Strip. Many Palestinian opponents, tribesmen, have been killed by Hamas since this ceasefire. They are patrolling the streets, and Israel, of course, continues to control 53% of the Gaza Strip.
Does anybody else want to send troops? Any other country?
This is a very, very important question. We have heard that the Egyptians are volunteering to lead this force. We've heard some about Azeri troops. We've heard something about Indonesian troops. None of this has materialized, however. And there are all kinds of questions about what are the rules of engagement for such a force? Are they going to be the ones to actually disarm Hamas? What happens when Hamas militants fire on an Indonesian soldier and kills that Indonesian soldier? None of these questions have been worked out. All we know about this international stabilization force is that there are 200 U.S. soldiers and officers outside the Gaza Strip who are there to coordinate a force that doesn't yet exist.
Why is J.D. Vance the person who's over there right now?
It's a really interesting question. I think J.D. Vance has, at times, raised questions about Israel's conduct, not just in Gaza, but around the region. I think this is another effort on the part of the president to show that everybody's going to be treated fairly. So despite all the smiles and J.D. Vance saying this is going to be a durable peace and the ceasefire is working, I think behind the scenes, Vance is there to apply pressure on Netanyahu to make sure that the Israeli government sticks to its obligations.
You mentioned the strike from September in Doha. There's some debate about the importance of that strike. Why was that pivotal in your mind?
Oh, I think it was very, very important. One, it didn't succeed. I think had it succeeded, we would be in a different place right now. But the president claims he was very unhappy about it. And Prime Minister Netanyahu took a ton of criticism, even from his Arab allies. So he was really on the defensive. At the same time, it really scared the Qataris. And so the president took both of those things and made something out of it. A softened up Netanyahu was vulnerable to Trump's pressure, and the Qataris needed something from the president. He said, okay, I'll give you a security guarantee, albeit in the form of an executive order, which could quickly be repealed, but you have to perform for me and you have to deliver Hamas.
I was there that day in the White House after they had that call with the emir, and it was embarrassing for Netanyahu to have to make that call, someone who was excited that they were potentially able to going to get these Hamas individuals with this strike. Trump was successful in phase one. How do you even bridge to phase two?
Well, that's, I think, the big question here. Every point on this 20-point plan beyond point one, with the exchange of hostages for a ceasefire, is subject to long negotiations. All the questions I just asked about the International Stabilization Force. There's lots of questions about who is a technocratic, non-Hamas governing body in the Gaza Strip after 18 years of being in power there. Any bureaucrat has got to be associated with Hamas. Where do you draw the line and say, okay, these are terrorists and these are people who know how to keep the lights on? The Israelis aren't going to want anybody who's affiliated with Hamas. That leaves them without really a technocratic government.
If you can't get to phase two, does this mean normalization between Israel and some other Arab states is off the table?
I think normalization has been off the table, given the fact that the Saudis, who are the big fish here, have said there needs to be a two-state solution for there to be normalization. And I think only 21% of the Israeli public supports a two-state solution. Maybe the Saudi price will go down 3, 5, 10 years. But I think we're back to the status quo where the Saudis and the Israelis are doing business, coordinating security under the table, rather than 3 years ago when Saudi officials were talking about it's not a question of if, but when we'll normalize.
Stephen, important perspective and appreciate your time.
Thanks for having me.
Thank you for being here. Thank you, sir. Stephen Cook there of the Council on Foreign Relations. Let's give you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahara Anand for more. Hey, Yahara.
Hi, John. AT&T shares are rising 2.6% in the pre-market. The wireless provider added more mobile phone and home internet subscribers than expected after a heavy promotional push. AT&T did miss slightly on revenue, but added full-year EPS should land in the upper range of previous guidance. The company is the first of the major wireless providers to report results. Meanwhile, India's Mint News is reporting the country is nearing a trade deal with the U.S. that could lower tariffs on Indian exports to 15 to 16% from current levels, which sit around 50%. The report follows comments from President Trump, who said India's President Modi assured him the country would pull back on purchases of Russian oil. The two leaders are scheduled to meet next week. And Amazon reportedly has plans to replace more than 500,000 jobs with robots in the coming years. Documents viewed by the New York Times show Amazon's plan to automate its workforce, allowing executives to double sales without hiring new U.S. workers. The Times also reports Amazon is so convinced this is nearing, it has started developing plans to mitigate the fallout in communities that may lose jobs. That's your Bloomberg Brief. John?
Politicians are going to need to do the same thing, that's for sure. Yahara, thank you. Up next on the program, Netflix stumbles.
We had a good Q3. We had revenue in line with expectations. Our operating income would have exceeded our forecast absent the Brazilian tax matter.
We compete with the biggest players in the world, tech and media. And as you see, we keep growing engagement, revenue, and profit.
That conversation up next with Jason Bazinet of Citi from New York City this morning. Good morning. You're watching Bloomberg TV. Stories like this might not matter to the broader equity market. It's a $6 billion company, but it certainly matters for the broader economy. Check out Mattel in the pre-market, down by 6%, sales declining. They miss estimates, and they flag that toy stores and US retailers are not buying product because they don't have the certainty around the tariff story. That's a big, big issue for the US economy.
Their argument is that they just pushed some of the orders back from the third quarter to the fourth quarter. And just hold on a second, because it's going to be really big. In the meantime, they're trying to wean themselves off China imports to the United States of things like Barbies. Hot Wheels are made more in the U.S. One other interesting thing, they also said, we're also partnering with OpenAI for things like the Magic 8 Ball. So, I mean, they're trying to sort of say, look, we're related to AI too.
Tried to get the algos to bite. in after-hours trading. Mattel down by close to 6%. This is a challenge. The retailers are important, of course. It's often said the American economy is the consumer. Things are changing, I know, but ultimately the holiday shopping season is massively important. And I think it puts additional weight on these negotiations between the US and China in the next few weeks.
Absolutely. And what we've seen from the president yesterday in his remarks is he wants maximum flexibility. He's talking about on November 1st, this new deadline he has. It could be north of 100% tariff on China if there's no agreement. And at the same time, he's saying, I think there'll be a good agreement if the meeting goes through. The meeting is not set in stone, is how the president is approaching this. He wants maximum flexibility before this potential sit down.
People want maximum certainty, and that's not available at the moment. Equity futures more broadly doing okay, positive by 0.1%. Under surveillance this morning, one other stock in focus, Netflix, stumbles.
We had a good Q3. We had revenue in line with expectations. Our operating income would have exceeded our forecast absent the Brazilian tax matter. We recorded our best ad sales quarter ever.
We compete with the biggest players in the world, tech and media. And as you see, we keep growing engagement, revenue, and profit. When it comes to M&A opportunities, we look at all of them, and we apply the same framework and lens that we look at when we look to invest in a build.
So here's the latest this morning. Netflix falling in the pre-market after the streaming company reported Q3 results bruised by a tax dispute with Brazil. Jason Bazinet of Citi keeping a neutral rating on the stock with a price target of $12.80. Jason joins us now for more. Jason, welcome back to the show. Always good to catch up with you, particularly after these numbers. Jason, when you strip out Brazil, what's left? What have you got?
Well, I would agree with the company. I mean, ex the Brazil issue, I would say it was a solid quarter. The area where I think the street is going to focus is the divergence in the growth rates. So what we're seeing on an FX neutral basis is the United States and Canada is hanging in there with good growth. But in all of the other regions, which is about 60% of Netflix's revenue, we're seeing revenue growth rates decelerate. And so that's important because if you're not going to get a beat and raise, and you're looking at 60% of the world or of Netflix's revenues decelerating revenue, that doesn't augur for multiple expansion.
Jason, do you see a content slate in the pipeline that turns that story around?
Well, the content slate is sort of a super leading indicator, and then you get the engagement, and then after that you get the price hike. And I would say that the engagement was actually record levels in the quarter. But I think they will end up taking pricing because of that. But even with that, you're probably still going to see decelerating growth. And I would say there's an issue that I'm more focused on strategically for Netflix, which is if I roll the clock back 5 years, Netflix had more engagement than YouTube. If you look at it today, YouTube has about 50% more engagement than Netflix does in the United States. That is a huge sea change that I think poses strategic questions for Netflix. They push back on this notion, but I think it's a big issue.
Well, Jason, just to build on what John is talking about, it seems like the excuse about Brazil is part of it, but really not the full story in terms of the reaction in the shares. It has to do with where the growth is going to come from. The growth so far has come from U.S. and Canada, which did beat, as well as Europe. But in Latin America and APAC, it missed some of the expectations. And it just raises a question. What's their growth strategy?
Well, I think it's going to have to come from pricing, and that's going to be easier to do in the United States than it is going to be in the rest of the world. They're also talking a lot about advertising being a big issue. That's also going to be much easier to do in the United States than it is in the rest of the world, just given the size of the ad market. And the third vector is gaming. The company's been working on gaming for a number of years, and they think it's going to be one of their major growth vectors.
How much do they need to do M&A in order to really gain in some of these areas, whether it's gaming or just in order to boost eyeballs and boost engagement enough to raise prices substantially?
I don't think that they need to do anything on the M&A front inside the traditional video ecosystem. There's a lot of talk about Warner Brothers potentially being for sale. I think that's very unlikely. In the video game space, I would say it's probably more likely. That is a very difficult business to enter into organically.
When you talk about their concern in terms of Netflix's biggest competition, you talk about YouTube. YouTube, you can get a free version of. How does Netflix compete with that?
Well, we're seeing a lot of fast services, the free ad-supported TV, other than YouTube, things like Tubi and others. Maybe there's a free version of Netflix, down the pike once they get this, ad tech stack stood up. Once they get aggregate demand, I wouldn't rule out a free ad-supported TV from Netflix either.
When could we see something like that? Are they actually in discussions about rolling something like that out?
No, not at all. But in the fullness of time, if the question is, how do they compete if this keeps going? That would be the logical response.
Jason, you also cover Warner Brothers, I believe. You mentioned the name, so let's talk about it. The previous strategy was pretty clear. The company wanted to split cable TV and then streaming and studios. Now they're open to a sale based on the conversations of the last 24 hours. Are they looking to sell the company whole or looking to split off individual pieces?
Well, I guess my narrative would be when the original purported buyer was Comcast didn't want the linear cable nets that were declining. That's why Comcast is spinning off Versant. And so Warner Brothers was trying to, align themselves with Comcast narrative. I think when Paramount showed up into the mix and said, hey, potentially we'll buy the whole thing, that's going to put pressure under Comcast to see whether they want to buy the whole thing or let the asset go.
So, Jason, do you think the last 24 hours is the start of a period of flirting with other players to get the original buyer to come back to the table with a better price?
Well, I think Warner Brothers is just there to maximize shareholder value. I would say where we are in the process right now is someone's going to probably have to buy all of Warner Brothers, and then if they don't want the linear cable nets, subsequently spin them out. But I think the likelihood of a split of Warner Brothers into two pieces is pretty unlikely at this point.
Jason, where are we in this process of sort of the disaggregation of media and now the reaggregation of media, where we can get basically the bundling that so many people have looked for? I mean, how far along in that process are we?
I think we're pretty far along. The way I describe it is, Netflix is the undisputed champ. Disney's sort of in the middle, and then you have these sort of three tier 3 streaming apps, which is Paramount, Peacock, and Max. And that's where we really need to see the consolidation among those three. The interesting dynamic, and this accrues to the benefit of Warner Brothers, is 3 is an odd number. So if we end up seeing 2 of those companies merge, someone's going to be left, holding the bag with really no cogent strategy for the future of video delivery, which is over the web.
And this raises a question also how we can view some of their earnings reports in terms of, are these utilities? Are these discretionary spending at this point? Can this give us a sense of how able consumers are to absorb price hikes? How much did you get the sense so far, based on what Netflix had to say, that the consumer is resilient, is buying, and is willing to keep spending and sort of ignore how high the bill is getting?
Well, I just go back. I mean, we at one point in this country, we had 85% of American households were paying $100 a month for video. We're nowhere near that point yet. So we're going to continue to see these apps go up. And so I'm not nervous about the resiliency of the consumer. I think the question is that we have sort of a lopsided landscape where you need to have enough content on your app to keep the churn down, to keep the consumer engaged. And as we sit here today, Netflix is the only one with the depth and diversity of content to do that, and the others don't have that.
They're just making it harder to cancel things. I was getting excited about cancelling Apple, and then what did they do? They got the rights to Formula One, didn't they? Of course, so now I can't get rid of that next year.
It was specifically for you. They're still trying to get you to upgrade.
They're out to get me. Jason, thank you, sir. Jason Bazinet of Citi. That kind of underlines the importance of sports content, though. That's what keeps this so sticky. These subscriptions just stay because people want to stick with the sports they love.
And it's the pay-to-view kind of aspect of this as well. I do wonder, though, what it means for the adoption for younger people. If they have to pay a lot in order to see the sports, whether they're going to subscribe to see every single baseball game. I'm serious. Like, I actually think this is actually a serious thing.
I don't think it's good for the sports.
I think it's actually pretty negative in terms of gathering younger people. So drop your prices so that people can be avid Mets fans.
We got a better deal in the 90s, didn't we?
We did.
It's got a much better deal in the 90s.
We still pay $100 a month for content. What is that?
And more.
Exactly.
Yeah.
Horrendous. Up next on the programme, Phil Camporeale of JPMorgan Asset Management, the Virginia Governor, Glenn Youngkin, James Foley of Rabobank, and Russ Brownback of BlackRock from New York City. You're watching Bloomberg TV.
Going to see the balance of risk shift back a little bit towards the inflation.
There's definitely inflation hazard risk.
We don't really see inflation momentum moving back down to 2%.
That sets us up for an environment where inflation certainly won't go back to target, but it might even accelerate.
You still have a very resilient and robust economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P positive by 0.1% following 3 days without losses on the S&P 500 and very close to all-time highs. The main event at the pre-market, this name right here, thank you Brazil, or not. Netflix down by about 6.5%. The outlook in line, though, and I think that's where the disappointment lies for that stock this morning. This one was better, Capital One, and I think this plays into the broader credit story at the moment. Yes, there are flashy headlines. Yes, we should pay attention. But Capital One at 4%, I think, alleviates some concerns about broader credit problems.
Especially because Capital One is more highly leveraged to some of the consumer lending that would signify that there is still strength in the underlying consumer, even in cohorts like the auto lending sector, in the credit card sector. They just purchased Discover. A real question here, how you can see a downturn in the economy if you see this type of activity right now and the Fed is cutting rates in the near future. This, I think, is what a lot of people are getting their heads around, which is why yields are lower and stocks are up.
We saw it with the banks last week. The banks were just stellar, upside surprise after upside surprise, beat after beat, and we've seen it in the last week as well. Looking ahead to next week, things get even more interesting. The Fed's on deck, decision a week today. Tech earnings, the big players kick off a week today, and a week away, we're going to have a conversation between the US and China at the very top level. The President of the United States should be sitting down with the Chinese leader. Might change.
Exactly. Should is the operative word. The president yesterday basically said both things. One, they think they're going to get a good deal, and he wants to see a good deal with China, but China needs to be fair. This is his words. And at the same time, he said, well, there's a chance the meeting won't happen, giving himself maximum flexibility, or maybe giving his Treasury Secretary maximum flexibility, as Scott Bessent will be going into this meeting really deciding on what these two countries could agree if it comes to the leader level. I think most people are expecting, at bare minimum, this is a punt down the road. You at least get an extension of where tariff levels there are right now. Maybe China loosens up some of the restrictions on rare earths, but this is all going to bleed into 2026.
Is there a price to pay for all this uncertainty? Are we starting to see pockets of that come to the surface?
You're talking about Mattel in particular, the idea that they came out. How much is it an excuse, though? Well, the reason why deliveries were a little bit low is because China, and we're not sure what we're going to do with the holiday shopping season. Look, there's got to be some truth to that in the sense that how much do you order toys that could be more expensive when you could redirect to domestically produced toys that aren't going to necessarily have the uncertainty of some sort of tariff extra cost. At the same time, it highlights how quickly the market is to punish any company that even raises the specter of tariff-related disruptions.
That name is getting punished. Mattel is down by more than 6% in the pre-market. Broader equities doing okay, just about positive on the S&P 500. Coming up this hour, we'll catch up with Phil Camporeale of JPMorgan, with investors looking to extend a record-breaking rally. Virginia Governor Glenn Youngkin, as President Trump pledges to revive American manufacturing, and Jane Foley of Rabobank on gold following a steep sell-off. We begin this hour with stocks holding near record highs, driven by strong earnings. Phil Camporeale of JPMorgan writing the following: earnings are off to a great start. We continue to expect heavy lifting from the Mag 7, driving 42% of earnings growth. Phil joins us now for more. Phil, good morning.
Good morning. How are you?
You said it a few times through the summer. I'm good, and it's good to see you, that we're moving from a period of uncertainty to certainty.
Right.
Has that story played out now?
Yeah, we truly believe that on both sides of the 60-40, John. So as an asset allocator, when am I ever able to come in late in the year, in the fourth quarter, and tell you that a globally diversified portfolio is up about 15 and the S&P is up about 15. Obviously, much less volatility on the asset allocation side. So both sides, again, certainty. What are the certainties here? The first one is my mark to market is 4.1% on the Federal Reserve on the 10-year Treasury rate. That's where it was on September 17th when they cut rates. And this morning it's at 3.95. Mark that as a win, because last year, oh my goodness, Fed cut by 100 bips. Everybody thought they were easing into a no recession, environment, go long stocks. And then in December, a bunch of coal was dropped in everybody's stocking because the 10-year note shot up. So the things that I'm looking at this year, John, particularly around the certainty is easing really easing financial conditions? And the only financial condition that matters to me is the 10-year Treasury rate, because of how much sentiment that drives around things like mortgage and bond.
So let's sit on that. I think it's really important. So you compared this story now and how it's playing out to what happened last year.
Yeah.
Again, I would say there are similarities. People think the Fed is cutting into an acceleration next year. That's what the equity market is priced for. The only difference is yields have dropped. They're not spiked. Right. And I think the conversation we've got to have is why are bond yields lower? Into potentially a hot inflation print on Friday and into another rate cut a week today.
Yeah, so I think growth is slower, right, in general. So last year, John, we were growing at about 3% in GDP. This year, about 2%. Into next year, about 2%. So that particular period, that particular kind of boost or just kind of thrust in the U.S. economy isn't as strong as where we were last year. And then I also think owner's equivalent rent is a big deal here within CPI. So goods prices, sure. Mattel could talk about, they're spiking prices on goods. But that owner's equivalent rent story that makes up roughly 60% of CPI continues a trend lower. And that is something that I think, goes into next year. And it's not just inflation, it's inflation plus growth. So nominal growth drives earnings. So we have a double-digit earnings forecast for next year. PEs can go sideways. You can get the double-digit earnings growth, and that could lead to double-digit returns on the S&P. So if you have about a 2% GDP story and a 2.5% to 3% inflation story, that's 4.5% to 5% nominal growth, which should be pretty good for taking risk.
The only thing that you said in there that some people might disagree with is that this is a soft economy. How can you say this is a soft economy with the blockbuster earnings that we have seen after one company after another, including in many retail sectors?
Yeah, so it's, again, I want to characterize that as we were going at 3 last year, 2 this year. So to 2% into next year is still above trend. So I wouldn't characterize that as soft, Lisa. I would just consider that as, characterize that as steady, resilient, consumer-driven growth. And I don't think that the multiple story should expand. I think it's more the earnings story, as you said, and the earnings look really good. I love the financial sector. People love to talk about tech. And you mentioned with Capital One, the financial story. Hearing CEOs like Goldman CEO talking about, okay, we now know what this environment is. Deal making, we think, can continue. You realize that deal making coming into this year, so M&A as a percent of GDP was the lowest since the dot-com era coming into this year. So now I think you have, kind of an administration that's going to say yes, but also going back to the story around rates, I think you have certainty on the rate story. If the older and wiser sage of the VIX, which is the MOVE index, is saying that this is the lowest rate volatility since 2021, I think CEOs realize that and can move forward to capital market activity.
Not to be overly cynical, but let's just say somebody wanted to buy banks at a better valuation, and they say, ooh, credit worries, and all of a sudden those stocks tank. Are you on the other side of that, just buying them up as quickly as you possibly can?
Yeah, so apparently there were cockroaches crawling around.
Who said that? Who said that?
We have a big, beautiful building, and there are no cockroaches, trust me.
And you're buying the cockroaches.
Exactly. So we saw those headlines last week. And I think when you have things like high yield spreads, Lisa, trading inside of 300, that's a lot of good news priced in, right? So if you have this event, I call it event risk, not fundamental risk. So if you have this event or headline risk hitting, you're gonna release some of that pressure in high yield spreads because they're trading so tight. But we would be buyers, right, on that backup because it's not fundamental risk. Think about Silicon Valley. Silicon Valley in March of 2023, most people were saying we're in a recession already. Right? And then you go to even August of last year, the Japanese yen carry trade, early August, SOM rule triggered, Federal Reserve wants to cut rates, fundamental or recession risk was elevated. That is very different than this time. I don't think that we have only a 20% probability of recession over the next 12 months. Nobody's really talking about recession. We have a fiscal policy hitting in January. So at least you add all that up, we would be buyers on backups of financials because we consider this more headline risk than fundamental risk.
But are you on high alert? That's how Capital One put it.
High alert is not how we would put it. No, I think a trademark of this cycle, Annmarie, has been the corporate balance sheet health and consumer balance sheet health. And, those are slow-moving signals. I mean, the consumer is paying 4.1% on their mortgage right now. The kind of wall of worry or the wall of maturity on credit really hits in a couple of years, not this year or next. So we are not on high alert when it comes to credit spread.
You say uncertainty is moving to certainty.
Yeah.
How exactly? The two biggest economies might sit down. The president go waivers almost back and forth every single day. We're in the middle of a government shutdown. What is so certain right now?
Yeah, so what matters to us was the fear of tariffs from earlier in the year that would raise probability of recession and or prevent the Federal Reserve from cutting rates. So now we have the certainty of we only have a 20% probability of recession. Federal Reserve is engaged in an easing policy. Annmarie, I don't know what's going to happen in 2026
well, what if we have a 155% tariff on China? Does that not lead to a recession?
That could change the calculus, Annmarie, for sure. So, but with the information that we know now, we are not penciling that in. And also, emerging markets are not pricing that in. So emerging markets is the number one performing asset class right now, year to date.
Phil, appreciate it.
Good
Thank
to
you,
see you
sir.
guys.
Always constructive and optimistic. We appreciate it. Thank you, sir. Phil Camporeale there of JPMorgan. Equity futures slightly negative, just rolling over, just a touch. We're down by almost 1/10%. With an update on stories worldwide with your Bloomberg brief. Here's Yohara. Hey, Yohara.
Hi, John. President Donald Trump says the upcoming meeting with Chinese President Xi would yield a good deal on trade. Still, Trump said the possibility remains that the meeting could fail to materialize. Treasury Secretary Scott Bessent is expected to meet with his Chinese counterparts to discuss the de-escalation of trade tensions later this week, ahead of the Trump-Xi talks. Meanwhile, President Trump is demanding the Justice Department pay him about $230 million in compensation for the federal investigations into him. The Times reported earlier that Trump alleged these were a violation of his rights. Any settlement might ultimately be approved by senior Justice Department officials who were once defense lawyers for the president. And AI firm Anthropic is in talks with Google for a massive cloud computing deal, potentially valued in the high tens of billions of dollars. The deal would provide Anthropic access to Google's powerful tensor processing units to accelerate its machine learning development. Both companies have declined to comment, with talks still in the early stages. That's your Bloomberg Brief. John?
Hey, Yohara, thank you. Appreciate it. More from Yohara in about 30 minutes' time. Up next on the program, Make America Manufacture Again.
We have record business. We're going to be, I think, by the time I hit month number 12, I think we're going to have $20 trillion of investment.
Up next on the program, the Virginia governor, Glenn Youngkin, joined us from New York City this morning. Good morning. The build-up into next week continues. A week today, a Federal Reserve decision in the afternoon, and after the close, we'll get numbers from the likes of Microsoft, Meta, Alphabet, the big players that make up a big chunk of this equity market. Equity futures just about unchanged this morning on the S&P 500. Very close to all-time highs on the S&P. On the Nasdaq, down by around about 0.2%. Mid-October, a lot still to play for into month end.
Yeah, and this is the reason why people maybe are taking some chips off the table, are trying to figure out exactly how to de-risk. But every earnings report has just reconfirmed this idea. Nothing's going that wrong. So if you want to find pockets of stress, you're not really finding it from the AI space. You're not really finding it from the consumer space. What are you going to worry about now?
That's the earnings so far. You can worry about China, I guess. The US and China sitting down, the President of the United States alongside the leader of the Chinese economy. And Annmarie, the negotiating doesn't start next week. It's already started. You see it play out in public. Every time the President speaks, he's negotiating.
And every time you get some sort of statement from the Chinese Commerce Ministry, most recently in the past 2 weeks, regarding rare earths and the fact that they are making it harder to have rare earths being exported out of China. And that's really what started the hot rhetoric between these two economies. Also, the fact that China's not buying any soybeans. Now, that is a huge issue for the president domestically when he sits down with Xi Jinping. We think he sits down with Xi Jinping.
We think. I think a lot of people hope. Let's talk about trade and domestic manufacturing. Under surveillance this morning, Make America Manufacture Again.
We have record business. We're going to be, I think, by the time I hit month number 12, I think we're going to have $20 trillion of investment. A lot of it's because of tariffs, because they're coming in because they don't want to pay tariffs. In other words, they make their product in a certain country and they used to just send it in here and there was no charge. Absolutely. Now, if they have to pay a tariff, they say, well, it's better if I build my plant in the United States.
So here's the latest this morning. President Trump reiterating his pledge to revive American manufacturing. The Commonwealth of Virginia securing $13 billion in new domestic investments between July and October of this year alone. I'm very pleased to say that joining the program now is the Republican Governor, Glenn Youngkin of Virginia. He joins us now for more. Governor, welcome to the program, sir. Always good to catch up with you.
Yeah, good morning, Jonathan. And it has been a very busy few months for us as we have welcomed a lot of manufacturing into Virginia, particularly from the pharmaceutical sector. And I think it demonstrates that we're leading not just in Virginia, but in America and reshoring this critical supply chain.
So, Governor, there's certainly a consensus we need to do more of that, produce more, manufacture more domestically here in the United States. Can you share with us what you've done in Virginia to attract more of that investment from overseas and bring it back home, and perhaps use Merck as a good example of that?
Yeah, we identified 3 years ago that pharmaceutical manufacturing had to come back to the United States. It's a national security imperative where all of the active pharmaceutical ingredients were being manufactured overseas, and a lot of them in China, and we needed to bring it back. But on top of that, we saw big investments coming from the pharmaceutical manufacturers, and so we prepared a great workforce development program. We lessened all of our regulations. We've cut almost 30% of our regulations in Virginia. And then finally, we made sure that we had sites ready for them. We're a business-friendly state ready to go. And then we went and recruited them. And you combine that with President Trump's strong push against the pharmaceutical industry to bring manufacturing to America. And we've just seen a huge drive of reshoring and investment. And yes, it's been $13 billion. Merck was our latest big announcement this week with a $3 billion facility to set up their active pharmaceutical and small molecule manufacturing center of excellence here in Virginia. They're gonna hire 500 people direct, and there's going to be thousands of indirect jobs plus construction jobs, and it's just another big step of bringing manufacturing home. I like to say made in America means made in Virginia.
Governor, we've also seen a lot of tech companies invest in Virginia. There's a lot of data centers in Northern Virginia. We've also seen, though, the cost of electricity prices go up. How are you balancing the two?
Well, we first start with an imperative to have an all-of-the-above, all-American energy plan. And that means that, yeah, we have to embrace natural gas and nuclear and, yes, of course, the renewables that we already have. But we've got to build a lot more power on top of that because Virginia is the data center capital of the world and we're seeing investment all over the state now. We also are driving bring your own power initiatives. And so power goes behind the meter. That actually keeps ratepayers whole so they don't get charged with a disproportionate amount of the cost of the infrastructure build necessary to support the data center industry. And again, this is a national security imperative that we're so pleased is happening in Virginia. You know, since I became governor, we've had $140 billion of commitments from businesses to expand here or come here, and that's manufacturing and distribution and research and development. And I think it just goes to show that when you create a business-friendly environment, we're a right-to-work state, we have deregulated, we have made sure we have the best workforce in the country, businesses will come and invest, and that creates opportunity for not just Virginians, but I think to supply in all of these critical needs that once were manufactured overseas, then they're all coming home.
You talk about an all-of-energy approach. The Trump administration has canceled federal funding for things like offshore wind and some renewable projects. Has that become a problem for you as you are dealing with higher electricity prices?
Well, it hasn't for us in Virginia. We, of course, have been really pushing to build new natural gas plants, and we hope to lead the nation in the development of small modular reactors, and we do have wind and solar projects underway. The reality is the previous Democrat administration in Virginia so underestimated the growth prospects of Virginia that we're behind, and that's why we're massively building in order to catch back up. On top of that, I do believe it's one of the great challenges for our nation, and that's why President Trump's initiative for energy dominance has to be a top imperative, because we're finding that, yes, when we're building data centers and advanced manufacturing and, of course, electrifying just about everything, power demand goes up substantially. We've seen China developing gas plants, nuclear plants like crazy, and we're behind. And so we have to build in America, and we need to do that fast so that we can not just catch up, but we can supply all of the reshoring of American manufacturing that is going to secure our future.
Governor, you really are at the vanguard in Virginia of a lot of trends around the nation, particularly when it comes to the labor market. You are bringing jobs back. You also have a heavy investment from the likes of Amazon, which just is supposedly on the way to replacing a lot of roles with robots. And I'm just wondering what role you see in terms of job training to try to adapt to a rapidly shifting backdrop in terms of technology.
Yeah, we have been out in front here because, of course, artificial intelligence particularly is now part of every aspect of the business supply chain. Of course, from design and engineering all the way through to manufacturing, marketing, everything is being fundamentally changed. And so we initiated, in partnership with Google, 10,000 AI credentials that allow folks free to come in and build their capabilities. And I think as we see technology rapidly transforming the way we do business, we have to rapidly transform the way we prepare our workforce to thrive in that environment. Listen, we got a lot of jobs in Virginia. We have 277,000 more people working today than when we started, 220,000 open and available jobs, and the $140 billion of capital investment underpins another 85,000 jobs and nearly 40,000 construction jobs. So we've got a lot of work to do here to prepare a workforce to take advantage of that opportunity. And I think making sure that workforce is AI ready is really important. And that's why we've been way out in front to make sure that that workforce is prepared for it.
Governor, I remember talking to you when you used to be at Carlyle, and you've had this incredible dual hat where you've been investing on one side in infrastructure, and then you are responsible for helping to plan and bring jobs in. I'm just wondering, does it concern you, some of the private investments that we've seen in some of the infrastructure spending and some of the speculation that maybe things could be getting a little bit frothy in that space?
Listen, the big difference that we're seeing now is the capital investments, particularly around data centers and AI and machine learning, are tied to business commitments in order to drive forward this transformation. And therefore, it needs to get invested behind. We need to see the power investment. And we're competing against China day in and day out. Listen, this is a race. We need to make sure that we have the appropriate stopgaps, and just in case that the application of AI begins to overwhelm the interface between humans and decisions. And my artificial intelligence executive order that I wrote last year said that we are going to incorporate artificial intelligence in what we're doing in government, but we're also going to make sure that we have people between advice and decisions. And I think that's one of our big steps. But with regards to the investment that we are seeing, I firmly believe that this investment will grow great capabilities, and those capabilities will be put to work. And that's why it's so important that we win the artificial intelligence race and not allow China to win it.
Governor Youngkin, just quickly, have you spoken to the Trump administration, Speaker Johnson, Leader Thune, about reopening the government? Because your constituents, hundreds of thousands of them, are not getting paid right now.
Yeah, the Schumer shutdown is such a tragedy because they're holding America and Virginia hostage at a time when they need to be doing their jobs, which is, of course, funding government. The Schumer Democrats voted in support of a clean CR 13 times during the Biden administration. There's a clean CR sitting on their desks, and they just need to vote and open up the government. I will tell you, we're starting to see some real pressures. I applaud the Trump administration for making sure that the military and law enforcement are getting paid. I know they're working hard to try to lessen the pain on the American people, but at the end of the day, we're starting to worry about SNAP benefits next month. And to say that the Schumer shutdown is going to hold hostage Americans who need support for food insecurity is absolutely crazy. And so we need to tell all the Senate Democrats, just go in, open up the government, and let's get going.
The opening about 2 hours away. Equity futures on the S&P 500 just a little bit softer. We're down on the Nasdaq 100 by 0.2%. The small caps negative by 0.4. The Russell just a little bit lighter so far this morning. As we count you down to the opening bell, let's get you some morning movers and cross over to Danny Berger for more. Hey, Danny.
Hey, John. Here perhaps is the reason for Nasdaq underperformance. It is Netflix down sharply in the pre-market. They reported earnings after the bell yesterday. For one, they had a tax charge related to Brazil that was over $600 million. So that was a black mark on their earnings. They did beat expectations in some areas, but maybe the expectation was even higher. The whisper number was maybe even higher, considering they had hits like K-pop Demon Hunter. They had a live boxing match that was really popular, so shares off 7% this morning. Of course, their name continues to swirl around a Warner Brothers Discovery potential deal. We also had some earnings this morning to work through. In the past hour, we heard from AT&T, those shares up 1 1/3%, beating on their subscribers. To be fair, they've had a lot of offers and deals to try to attract those subscribers and beat out their big rivals in Verizon and T-Mobile. Nonetheless, they've also been investing in their systems, in their coverage as a whole, so that seems to be working out for AT&T. We also heard from Hilton this morning, too. They did boost some of their financial metrics for the full year, hence the rally of 3%, but they did flag a lower occupancy rate than they had expected. But in the look forward, the company saying things are getting more certain for us. We hope tax policy, regulatory policy, general government policy will be more certain. That should boost growth, not to mention there is more demand for hotels and there is supply right now. So that's helping them out. John.
Hey, Danny, thank you. The stock is higher by a little more than 3%. More from Danny in the next hour. On a radar this morning, President Donald Trump threatening 155% tariffs on Chinese goods if there's no trade deal by November. The president planning to meet with the Chinese leader later on this month, but warning the meeting might not even happen. Elsewhere, the second half of Treasury Secretary Scott Bessent's $40 billion rescue package for Argentina could be in jeopardy. Banks involved in the $20 billion financing deal are still working on the terms, structure and collateral, with just days before Javier Millei's midterm election. And finally, Amazon planning to automate 75% of its operations and replace more than 500,000 jobs with robots. The New York Times reporting the company hopes to avoid adding to its U.S. workforce in the coming years while doubling sales by 2033.
And this, to me, is one of the key templates to see how much jobs can be replaced by AI. This was a company that tripled its workforce since 2018. It's one of the biggest employers out there. Whether these jobs are the ones that people want to be adding to the United States is a real question, whether we need it to be, given the fact that the population, the demographics are shifting, another question. But to me, this is the epicenter of the concern about AI and what it means for the job market, given the fact that they're already talking about mitigation in certain communities that could be affected by this.
Look, this is a political problem. It's an economic issue as well. The additional growth we're going to see is going to be very energy intensive. It's not going to be as labour intensive. And that is a problem for anyone sitting in a political seat anywhere across this country.
Can you imagine losing your job and then coming home and seeing your electricity bill up 15, 20% higher and you've just lost your job? All of it comes down to artificial intelligence. This is potentially going to be the fallout of this new technology. And to Lisa's point, what you're talking about the New York Times, they're looking at potentially the fallout in some of these communities that they are consider building a good corporate citizen role. Toys for tots, parades. Well, I'll tell you what, people don't want that. They don't want handouts. They want to keep their job.
Without a doubt. Amazon in the pre-market, just a little bit lighter this morning. We're down by around about 1%. We'll get earnings from them in about a week from now. Let's turn back to markets. What a move in gold. Extending losses after its steepest sell-off in over a decade. The precious metals record run before yesterday, sparking concern of a US debasement trade. James Foley of Rabobank debunking that theory, writing debasement would imply a move away from the dollar and US treasuries into assets such as gold. And there is very little evidence to back up these flows. Jane joins us now for more. Jane, welcome to the programme. It's been a really curious year because the narrative around foreign exchange was born in one quarter, and it was the first quarter of 2025. And I find it difficult to find evidence that the rest of the year really jives with that narrative at all. We had a big blast of dollar weakness. Jane, what's followed?
Well, you're quite right. I mean, most of that dollar weakness was really done in the first 5 months of the year. And ever since, well, actually, over the last month or two, I keep on finding myself saying, well, no, actually, the dollar isn't weak. It's been one of the better performers. In fact, I think it's a better performer right now in the month to date and perhaps over the 1 month view, too. So actually, essentially, if we look at the dollar index, for instance, that's sort of gone nowhere since the beginning of July. And what are we looking at in euro dollar? You know, a currency, the dollar that is certainly well off its lows versus the euro. So we aren't looking at a weak dollar as we stand. But yes, the theme really was set at the start of the year by that huge bout of dollar weakness.
So, Jane, let's talk about reality and the last few weeks, and then we can get to the peculiar move yesterday, the wild swing we saw in gold. More recently, we have seen gold rip higher, started to go vertical the middle of August and never looked back. And alongside that, we did have dollar strength participate as well. So, Jane, what explains those moves? What's the relationship, if there is one, between the two?
You know what? I mean, normally, of course, when you get a stronger dollar, then a profit taking sets in. And I think with respect to gold, yeah, there are good reasons, I think, for many portfolios to think about diversification this year. And I think that's still a valid theme. And I think gold, can be held along those lines. But, I do think there was lots of FOMO, a phrase that I've heard, in your channel quite a lot over the last few weeks. And certainly, at the start of this week, the Australian press were showing pictures of retail investors queuing round the block to get their hands on some gold. And I think for many institutional investors, that was perhaps the last straw. So profit taking pushed in as well with the stronger dollar. I think as we go into next year, there's probably still a theme, a reason to diversify our portfolios, and maybe gold again is part of that. But I think it is going to struggle quite clearly to match those very recent highs in the very near future.
Jane, is the concept of debasement just overly binary, and there's something else afoot that is maybe along the same kind of theme but isn't quite as strong, which is more people are considering that the dollar isn't the only thing in town. There was a discussion yesterday about how Ethiopia was trying to transfer loans that had been dollar denominated into UN. I mean, honestly, this is not necessarily something that's going to cause alarm bells everywhere, but there is the sense that people are looking for alternatives. At what point is that a realistic narrative to really play into your calculations?
I think we probably could be having the same sort of conversation in 20 or 30 years' time, that there is a theme of, reduced dollars, for instance, in global reserves. And, we can trace that theme back, to the start of this century, if we like. There is a theme also, in China, they want to internationalize their currency a lot more. The euro, we've heard several times from Christine Lagarde from the ECB since the spring this year that she wants to have a bigger role for the euro on an international basis. So we can assume maybe the euro will make some progress, and renminbi will continue to make the progress that it's been making. But the dollar has a massive advantage. It's already a huge transactional currency around the globe, across Africa, across Latin America, across Asia. And the US Treasury will be making attempts, to protect that, not the least with stable coins. So it is going to be something that the US Treasury will fight back on. But yeah, there might still be incremental benefits, perhaps in internationalization for renminbi, for euro. But I still think that those gains are going to be really quite modest.
Jane, how many questions do you still get about Bitcoin?
Not that many, more about stablecoin. I think this year less about Bitcoin. I mean, Bitcoin, certainly very much in the news, but I think most people have come to terms with this. This is something like, it's an asset, perhaps it's part of that diversification story again. But it used to be perhaps a different type of comprehension about where Bitcoin was, and perhaps a misunderstanding that it was a currency in the way, that the yen or the euro, that the dollar was. And I think that misunderstanding really now has more or less ebbed away.
Jane, when it comes to gold, if there's too much momentum and that's starting to wane, what do you make of everyone talking about $5,000 an ounce next year?
I think if we were to look at, really big movements, we'd have to be looking at, significant movements in the backdrop for the world economy. So maybe, we would have to be expecting or seeing a shock rise in inflation, perhaps, or, maybe more geopolitical tension, perhaps. And I think if we were looking down those lines and seeing that type of stress, then I think that there is perhaps the reason to carry on moving into gold, and it's, because of its intrinsic value, etc. But, we're not looking at huge amounts of inflation anymore. I mean, if we go back, to the start of the year, people were panicking about the degree of inflation that we could see in the US. We're not panicking anymore. We're seeing far more moderate types of inflation. Yes, we're still focused on, the potential for worsening in the trade front, which could create inflation. But there isn't that panic anymore. And assuming that we don't get panic either on inflation or the geopolitics, then I think these sorts of gains are really going to calm down for gold.
Jane, wanted to finish on the move of the day in foreign exchange as sterling. Inflation came in a little bit lighter than expected. Yields are down across the curve, particularly at the front end. We're now down by about 11 basis points on a 2-year gilt this morning. Sterling's a whole lot weaker for a fourth session, 133.17 out the corner of my eye. Jane, what's behind the latest move? And do you think the Bank of England will embrace this move lower in inflation and ultimately deliver more rate cuts?
I think there's still a wild card here because, yes, the inflation data was better than expected, lower than expected. But yes, it's still well above where the Bank of England wants it to be. But between now and the December Bank of England meeting, which is the one the market is now focusing on for a possible cut, we do have that November 26th budget in the UK. And there is speculation that Rachel Reeves may cut VAT on energy bills in order to bring inflation down further. And that maybe could give the Bank of England the sort of confidence that they need to cut interest rates again soon.
I don't think anyone's looking forward to that budget. Jane, thank you. Jane Foley of Rabobank. Jane, thank you. 1:33.18 on cable this morning. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. OpenAI taking on Google with its first artificial intelligence-powered web browser called ChatGPT Atlas. The browser features an Ask ChatGPT sidebar that lets users engage with website content and tasks like booking flights and editing documents. Atlas will be available globally on Apple's Mac OS to start, with plans to expand to Windows, the iPhone, and Android soon. Meanwhile, Walmart has paused offers to candidates who need H-1B visas. Sources telling us here at Bloomberg, the current guidelines primarily impact the retailer's corporate employees. The move follows the Trump administration's decision to raise the visa fees to $100,000. Walmart is the largest user of H-1B visas among major retail chains. And shares of Six Flags are slightly lower now, but they were up 18% yesterday as activist investor Jaina Partners and co-investors, including Chiefs tight end Travis Kelce, pushed for major changes. The group, which has built a stake of about 9% in Six Flags, is suggesting it refresh its marketing strategy and consider a range of strategic options, including a sale of underperforming parks or the entire company. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, the Federal Reserve's crystal ball.
If you want to have a Fed view, talk to the 2-year. The 2-year yield is the best crystal ball on Fed policy, and it just told you that the Fed's going to have to act more aggressively on cutting than it did before this week.
That conversation up next with Russ Brownback of BlackRock from New York City. You're watching Bloomberg TV. A week today, the Federal Reserve decision just around the corner. Most people anticipating the Federal Reserve will reduce interest rates all over again, another 25 basis points. And most people also think the Friday CPI report is totally irrelevant to the story of whether they decide to go or not. They will go, based on all the research I've read on the South Side. Going into this decision a week away today. Equity futures on the S&P 500 down this morning by 0.1%. Some underperformance on the Nasdaq 100 down by 0.3. Netflix stumbling, not helping that index this morning at least. There is a conflicting story in the financials though. Credit and all the concerns of the flashy headlines really competing with solid earnings across the board from the big players and the regionals too. Saw it from Zions earlier this week. Saw it from Western Alliance overnight as well. Equity futures down just about across the board. In the bond market, 2s, 10s, 30s shaping up as follows. 2-year bond yield to look like this. 344 on 2s. We're down a single basis point. 10s down 2 to 393.78 and 30s around 450. All the fear about bond yields parked. Yields have rallied. They've dropped big time. We do get some auctions, Lisa, a little bit later. 20-year bonds coming to market.
Yeah, $13 billion, which could test some of that appetite, although right now it doesn't seem like that's really much of a test. I keep going back to what Earl Davis of BMO said yesterday, which is that investors can only think about one thing at a time. And right now they're thinking about the Fed cutting rates. They're not thinking about inflation. And that is something that everyone's going to look through. So bond yields are going to keep going down as the Fed cuts. Go reconcile that with last year. I know, but that's sort of where we are right now.
As I'm speaking, a chat box pops up on a Bloomberg terminal. Guess who? It's Neil. Neil Dutta writes in, of course they will go. They're not stupid. Thank you, Neil, and good morning. And the surveillance this morning, the Federal Reserve's crystal ball.
If you want to have a Fed view, talk to the 2-year. The 2-year yield is the best crystal ball on Fed policy, and it just told you that the Fed's going to have to act more aggressively on cutting than it did before this week. We haven't even gotten to a recession yet or any real liquidity event. When we get there, I think the Fed's going to have to cut more than the markets think.
So here's the latest this morning. The latest interest rate decision from the Federal Reserve just 1 week away. Traders now betting on more aggressive policy easing into year-end. Russell Brownback of BlackRock writing the committee is expected to reinforce its dovish pivot. Forward rate expectations imply continued easing through 26. 100 basis points or more is possible. Russ joins us now for more. Russ, good morning.
Hey, good morning.
Let's run with that. 100 basis points or more is possible. What does the data look like in a world where they're reducing interest rates that much?
So, it's a continuation of the trend you've seen over the last 2.5 years, which is a decided disinflation. If you look at core PCE on a trailing 6 or 12-month basis, it's really pretty much a straight line down, save for a sort of stalling of that evolution because of tariffs. We've talked before about, I don't think tariffs are inflation. It's a one-time price level increase. And if you strip the tariff impact out of trailing 12-month core PCE, it's down around 2.5%. We think on its way back, eventually toward the low twos, which is where it's priced in the break-even market today. So with a policy rate in the fours today, we think it's very pragmatic for the Fed to be delivering what's priced into markets.
And it looks like they will go again next week. You talked about the disinflation. What's the source of that disinflation? What makes that durable and sustainable in your mind?
So, to start with, it's a secular disinflationary environment. You think about billions of consumers connected in real time, with smart devices and the like, perfect information about the economic value of everything. It's really hard to have pricing power in that environment. You think about the culture of corporate America today. You've got oligopolies in most major industries today, but instead of sort of being rent-seeking, you've got companies trying to take still more share because they're getting rewarded in markets through valuations by being bigger and having more share rather than by raising prices. And consumers are smart today, so consumers will substitute if something in the basket goes up too much, and they'll buy something different. So that is the secular environment we live in today. The biggest single piece of core inflation is shelter. It's always a lagging indicator. Every single piece of our proprietary data or publicly available data, whether it's multifamily, whether it's single family, suggests that there's a lot more progress coming on that front. So, we think a year from now, inflation will be convincingly down into the mid to low twos.
As you were talking about the efficiencies, I'm thinking, why are my BlackBerries still $8? I mean, there still are sectors where people are very much feeling cost of living increases that have been pretty intolerable for huge sectors of the economy. I mean, that was a reason why a lot of people say that Joe Biden became so unpopular later in his presidency. I just wonder how much we're creating a narrative around oil prices that have come down so much, around the costs that we have not yet seen from the transformation to a digital society that is much more reliant on the physical world that we haven't built out.
Yeah, no doubt. And I think what you're describing with your blueberries, or anytime you walk into a restaurant and you see a very expensive steak, you have sticker shock. But I think that angst is over high prices. It's not over ongoing increases in prices. The Fed's mandate is price stability. If you look at the volatility of inflation today, it's all the way back down to pre-pandemic levels. So the war on price stability has been won. Now the thing to focus on are the broad swaths of the economy that are being hurt by real policy rates that are as high as they are.
So why have people gotten conviction that any Fed cuts now won't necessarily cause a reacceleration in some of this inflation? I'm thinking about the housing sector in particular. Low rates, suddenly people can take out bigger mortgages, pay more for those homes, and suddenly that progress goes the other way.
So again, I would point to the secular environment that is disinflationary to begin with. And in the housing market, you've got an affordability crisis that's incredibly acute. You've got turnover for existing homes, which are 90% of all homes that turn over are existing homes, down to kind of GFC, post-GFC kinds of levels today. So to bring the rate down, you've got trillions of dollars of pent-up home equity that can be tapped into. If you look at the refinancing index for the U.S., it's doubled since June with this rate rally we've had today. So there is relief coming for the housing market. That's welcome relief. You've got millions and millions of households suffering from this policy stance today.
When it comes to the housing market, though, last year, mortgage rates went up even as the Fed was cutting. Will that happen again?
So, I think I love this narrative that, gosh, the markets protested the Fed cutting last year. You had a deeply inverted yield curve coming into September last year. The markets were pricing in a hard landing. When the Fed cut 50 and then signaled that they'd be delivering more cuts as the year went on, the markets started to price in a soft landing, and the curve steepened as a result. Then you got the election. Markets guessed that was a growth-friendly, cocktail policy mix, and curves steepened further. And then globally, fiscal policy sort of spigots opened up. Curves steepened globally in deference to the higher likelihood of a soft landing, not in protestation to cuts.
Are you loading up on bonds then, Russ?
So no, actually, I think the market...
Come on, Russ, what's happening here? This is the big framework. It sounded so bullish. What's happening?
So, what we're bullish on are yields and income. So the yield curve today, the front end's priced to that sort of Fed target that we talked about. The back end will always gravitate around nominal GDP growth outcomes. So there's not a huge directional trade today, but because the Fed's delivering, because fiscal policy's supportive, because the structural underpinnings to the economy are good, it's a great environment to own credit, securitized assets on top of the risk-free curve and harvest income. The aggregate index right now is annualizing to almost a 9.5% return. This is a great environment for clipping coupon.
Can you say the same about the rest of the world? That's the United States. What about everybody else?
So, we actually think a diversified exposure, we're taking our multi-sector portfolios globally. When you look at swapping European credit, high yield investment grade, even some of the peripheral sovereigns back to dollars, when you look at Asian sort of credit assets swapped back to dollars today, you can get very, very attractive yields. And of course, diversification in a very bifurcated economy is the way you sort of risk mitigate when you're seeking yield.
You're going to take a long breakfast Friday morning and just ignore CPI? Feels like most people are.
Well, I think it'll be very interesting to look at the component parts. We're particularly focused on the shelter pieces we talked about at the onset of this discussion. We expect there will be a resumption of a deceleration of shelter. That's the thing that we want to look at in the inflation indicators going forward.
Russ, thank you, sir. Always the clinic.
My pleasure.
It's good to see you. Thank you. Russ Brownback there of BlackRock, breaking down the fixed income market. Looking ahead to Friday's CPI report, the amount of notes we've all read that have basically just said this Fed's going to go, this Fed's going to go. It doesn't matter what that inflation number looks like on Friday.
People are going to say it's noisy. People are going to say that going forward, they're going to look past this because of the one-time price shocks, and they're going to talk about shelter. They're going to talk about oil. They're going to talk about some of these other inputs that are going to be mitigating factors to, your Hot Wheels that you might be getting for the Christmas.
Maybe if the retailers buy them. Because right now they're not stocking up.
That's true. I mean, that's the creativity and the reason why maybe we haven't seen the prices go up.
But remember, the President of the United States who said a few months ago, if you're a 9, 10-year-old girl, you don't need $37.
You need one.
You need one.
Yes.
I don't think that's going to work on Santa Claus Christmas morning.
No, I don't think that works on December 25th either. If you're looking at the bond market this morning, we're down by a basis point, 344 on 10s. We're at 394, so the front end of the curve coming down, the long end as well. We're down by a few basis points across the curve. Equity futures doing okay on the S&P 500, just a little bit softer through most of this morning. Coming up in the next hour, we'll catch up with Darrell Cronk of Wells Fargo, George Gianarikas of Canaccord, Yelena Shulyatyeva of the Conference Board, and Christian Mueller-Glissmann of Goldman Sachs. The third hour of Bloomberg Surveillance is up next.
I think this kind of AI CapEx cycle still has room here.
Right now, you got to be bullish.
How many articles are you going to read about a bubble in AI and not start to be a little bit worried?
A lot of the speculative fervor has been outside the mega cap tech areas within the market.
I do think we're overlooking some of the flags that have been waving.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. You're watching Bloomberg Surveillance and your third hour starts right now. The scores look like this. Equity futures on the S&P 500 just a little bit lighter, following 3 days without losses on the S&P 500. On the Nasdaq, we're down by about 0.3%. Some losses for Netflix overnight continue throughout this morning. The attention will shift very quickly to earnings later, and the main event is very much about Elon Musk and Tesla. Huge pull forward expected for this quarter indicator of demand. We've seen that in delivery numbers. What's the rest of the year going to look like and beyond in 26?
And what's the hit from some of the tax incentives that will be rolling off? Does he speak about demand in China and the competition there? And how much does Elon Musk try to pivot to the idea of self-driving vehicles as the hopes and dreams that he can keep using to fuel some of the valuations that we have seen? It's going to be a real question around the epicenter of a whole host of different themes, from autos to trade to also what the future of technology is going to be.
Southwest in focus as well. We've seen the big airlines, fantastic numbers. Delta Airlines, brilliant. You'll catch up with American Airlines tomorrow morning. Southwest could be a very different story. That's a different segment of this economy.
We've heard incredible earnings from United and from Delta. The expectation is that American will have a similar story. Is it in aggregate all of travel, or is it specifically tied up in the big three to the detriment of some of the lower cost airlines like Southwest that do cater to people who are more middle class, more cost conscious? This is the true test, and whether we see that K-shaped kind of economy. I wonder how much Hilton's going to talk about that in their press conference later this morning.
Look out for that a little bit later. If you're looking at the broader equity market, we're doing okay. We're just about unchanged on the S&P 500. Coming up this hour, we'll catch up with Darrell Cronk of Wells Fargo as stocks are edging lower. George Gianarikas of Canaccord with test the earnings on deck later on today. And Yelena Shulyatyeva of the Conference Board as we're counting down to CPI data on Friday. We begin this hour with stocks holding steady as Wall Street awaits the next round of corporate results. Darrell Cronk of Wells Fargo writing, based on our expectations for accelerated earnings, we believe the next 12 to 15 months will favour US equities. Darrell joins us now for more. Darrell, good morning.
Morning, John.
What is it about the US stock market that this story is going to favour?
Well, I think it's a number of things. So beyond the earnings story, which I think you guys have well socialized and talk about and has kicked in, I think you've got a lot of certainty that is coming in vogue, right? I mean, we know the Fed's going to cut interest rates. We don't know exactly by how much and when, but we have a high degree of certainty that monetary policy is going to ease financial conditions over the next 12 to 15 months. We know the fiscal rules we're playing by now. We had the One Big Beautiful Bill in July. There is no One Big Beautiful Bill 2.0 in the remainder of this president's term. So if corporate America is waiting around for mergers and acquisitions and CapEx and everything to kick in because they were uncertain, let's say last April with tariffs and Liberation Day, now they're much more certain. And there's a lot of stimulus corporately in that One Big Beautiful Bill. There's also a lot of stimulus in there for the consumer as well. I mean, there's going to be big tax refunds in the first quarter next year that people are underestimating right now that will kick in. And history tells you the consumer spends $1.17 of every dollar they get back in a tax refund, right? So they overspend what that is. So there's I think, a wave coming that will push through for corporate America and continue to drive that margin line and the bottom line earnings.
So the sector you like, your favourite, is financials.
Yes.
Just moments ago, the team at Bloomberg broke a story. I'm going to share it with you. Reads as follows. According to people familiar with the matter, the Federal Reserve has shown other US regulators the outlines of a revised plan that would dramatically relax the Biden-era bank capital proposal for Wall Street's largest lenders. I'll spare everyone the details. You can read through the details and have a look at the story. But ultimately, this feels like the direction of travel here.
Absolutely.
How big a pillar is that of your long on financials?
So deregulation is a pillar, and it matters greatly to the G-SIFI banks, right? I mean, I think to your point about where Basel III was heading, say 12, 18 months ago to where it is today, huge 180-degree turn just in the sentiment. I think what's more important, though, is probably two other pillars. One is, M&A and CapEx kicking in, right? So you get this whole kind of, what we thought was going to be the merger acquisition cycle that was going to happen for all of 25 that got delayed because of tariffs. And more importantly, and most importantly maybe is the right way to say it, we think we have a high conviction the yield curve is going to keep steepening, right? I know it's kind of flat in the last couple of weeks, but if you think about this, if the Fed is going to cut interest rates and you're not going to get a recession, right, then those term premiums on inflation and growth on the long end of the curve have to come up, right? So the Fed's going to hold, let's say, short-term rates, the long side comes up steepening, right? If we're wrong and that doesn't happen, let's say we're on the precipice of a recession or a slower event that we don't know, then what has to happen? The Fed has to cut interest rates more than what's projected by the market right now, drives the short end down, steepening, right? So in both cases, when you war game this out, I don't see a way that you don't end up with a steeper curve. Steeper curve favors financials.
I'm looking right now on the heels of what John was just talking about. Bank of America, Wells Fargo, JPMorgan, the Shires futures all got a pop on the heels of the latest note of deregulation that we're seeing. I'm just wondering whether this is a read-through to the broader economy or whether this is a financial specific sector. I mean, that's sort of the initial read on earnings has been incredibly positive on the backs of financials, but financials haven't been as tied to the broader consumer economy as much as in the past. So how do you pair those stories?
Well, I think, when you look at after last week's, let's call it credit scare, right? When the regional banks and what's happening in some of the private credit markets and stuff, we just don't see it, right, in the loan portfolios. The consumer remains strong. The small, medium-sized businesses remain strong, right? So the lending portfolios of these banks are pristine. Then you couple that with the investment banking piece kicking in and really driving earnings, a steeper yield curve, right? All the stars kind of line up. Now, when you get all the stars lined up, the problem is something could go wrong in that equation, but we don't see it. To your point on deregulation, though, I would unequivocally say it's not simply a financial story, right? It spills into the healthcare sector, it spills into the energy sector, right? It spills into, frankly, the industrial sector on the reshoring of a lot of the manufacturing, and that element. So I think all of that plays in and probably drives margin and earnings into 2025. It's 2026, sorry. We're actually very bullish heading into next year.
So when was the shift? Can you just walk us through the psychology? Because I remember talking to you a couple months ago, and you did not sound this positive. And a lot of people seemed a lot more worried. And suddenly everyone who comes on the show, no one can kind of find the real crack in this veneer right now. They're trying, believe me. When did you really start to say, hold on a second, I need to upgrade my expectations and be more pro-risk?
I think in the middle of the summer, right? I think the summer when we started to see where the Fed was taking monetary policy, when we knew the fiscal clarity was kicking in, you get these big kind of multi-year secular trends of the revitalization of manufacturing, AI, of course, all that stuff. Those are things that when you get, I wrote a piece here not so long ago called, getting through the noise, getting the signal above the noise, right? And you start looking at these secular trends that we think have legs for maybe the next 2 to 4, 3 to 5 years, they're powerful, right? And when they all align simultaneously, that creates a unique environment that you don't see very often, right? Where you get manufacturing kicking in, you get technology continuing to do well, you get monetary and fiscal policy alignment, right? I mean, all those things can actually drive corporate earnings, and you also reduce some level of uncertainty. I know the day-to-day noise around uncertainty is high, whether we're going to have, a Trump meeting and, all those kind of things. But I think all of that starts to come down, and you look through that out in the next 2 to 4 years, I think America does really well in the next couple of years.
So what worries you next year then if you feel like you've gotten a lot of clarity in 2025?
So it's an interesting question. I would say the 3 I's, right? I think that this is what I wake up and kind of pay attention to. Inflation, of course, right, which we'll get the reading Friday. Interest rates, what happens? Because, if interest rates come down too far, you have to start asking the question, why are they coming down so far, right? There's a point where lower rates is good, and then all of a sudden lower rates start to become bad. And the third one that doesn't maybe get as much airtime is illiquidity, right? I mean, if you look at what's happening in the repo market, you're seeing reserves drain down in the banking system, which is why I think here in October, Powell will come to the table and say, we're going to start setting the stage to ending QT. QT is worth, by our math, another 25 basis point interest rate cut. So if we get a 25 in actual Fed funds in October, you get QT happening. There's another 25, you get 25 in December, right? All that starts to add up.
When you say interest rates going so low and you have to question why, is it because the economy is so bad, or you think they're being jawboned by the White House?
Well, the reason might be the latter, but I think when you start getting interest rates lower, you have to start saying what's going on there, right? Is it a true flight to quality, or is it just the whole curve shifting down, right? And once you get that flight to quality element and narrative that enters the discussion, that's where you have to kind of pay attention. We're not there yet. We don't think we're going to be there, but that's what you would want to watch for.
Fed race has gone quiet, hasn't it?
It has.
It's gone really sleepy.
Well, because they're cutting interest rates. So I don't think there's this sense of urgency that Trump or Bessent had as they had in the summer.
Darrell, good to see you.
You too.
Thank you, sir. Darrell Cronk there of Wells Fargo. Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Meta is looking to cut about 600 jobs from its AI unit. According to a memo seen by Axios, the cuts will look to make AI efforts more agile. At the same time, Meta is expected to continue hiring for its newer TBD lab, named that since it doesn't have a name yet. Affected employees will be encouraged to apply for other jobs internally. Meanwhile, peace talks between Russia and Ukraine are showing signs of stalling after White House sources said there are no plans for a meeting between President Trump and President Putin. The leaders had been scheduled to meet in Budapest within the coming weeks. The Kremlin on Tuesday maintained that Russia is sticking to its original demands, including Ukraine cede full control of the Donetsk region. And Japanese Prime Minister Sanae Takaichi has ordered a fresh package of economic measures to ease inflation. The package will include subsidies for electricity and gas charges during the winter and regional grants to ease price pressures. The package aims to strengthen economic security and defense and respond to U.S. tariffs. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate the update. Thank you very much. Up next, the morning calls, plus George Gianarikas of Canaccord with Tesla earnings on deck later on today. That conversation up next, live from New York City. Good morning.
Hearing CEOs like Goldman CEO talking about, okay, we now know what this environment is. Deal making, we think, can continue. Now I think you have, kind of an administration that's going to say yes, but also going back to the story around rates. I think you have certainty on the rate story.
What a year the banks have had so far. That was Phil Camporeale of JPMorgan Asset Management. We just spoke to Darrell Cronk. Favorite sector, guess what? Financials, the banks. Equities at the moment on the S&P 500 just about unchanged. If you're looking at the Nasdaq 100, we're down by about 0.2%. On the Russell, we're down by 0.4. That's the price action. Let's get to your morning calls. First up, Jefferies lowering its price target on Mattel to 23, emphasizing caution due to the toy maker's reliance on a strong holiday season. Your second call from Morgan Stanley raising its target on Hilton to 289, citing stabilizing trends and better hotel development. And finally, Piper Sandler cutting its target on Netflix to 1,400 after earnings, highlighting light operating income due to a tax dispute in Brazil. The stock is down by close to 8%. Let's stick with the earnings. Tesla to report today after the closing bell. Bloomberg's Craig Trudell joins us now for more. Craig, welcome to the program, sir. What a 24 hours for the likes of General Motors. Do you think Tesla can repeat the act?
Yeah, I mean, it's going to be a tough ask because on one hand, this is a company that is coming off a really solid quarter of EV sales. They're the most that they've had in a quarter ever. And yet the sort of go-forward outlook, I think, is going to be the real rub. And, we've heard that, from Elon Musk himself 3 months ago when he talked about this notion that once we see EV tax credits go away in the U.S., that Tesla could be in for, in his words, a few rough quarters. And I think that's, sort of something that's reinforced by what we heard from GM yesterday and in the lead up to their earnings, that this is a case of just a sort of widely held view that EV uptake is going to slow pretty dramatically in the U.S. without these incentives. And that leaves, companies like Tesla that only have that to offer in a bind for quarters to come.
Craig, do you think there's the potential for more positive framing of the same story? With this in mind, GM are pulling back, others are pulling back. They're more of a purer play on that story. Doesn't that give them the space to succeed, space they otherwise wouldn't have had?
I think you can try that. I guess the concern is that, maybe you have more of the pie, and yet that pie is going to shrink so much in the U.S. at least, and it's already the case that, to Tesla's credit, that they are so dominant in this segment of the market. So even as we're seeing, the likes of GM and Ford saying, look, we expect this to really shrink, it's not as though they're completely doing away with their electric vehicle models that they have on offer. They're just sort of counting on demand for those models, dropping along with demand for, the Teslas that are on the market. And so, I would not be surprised if we heard some of that spin. And I would sort of also anticipate that Musk will lean into sort of brighter, shinier objects like humanoid robots and driverless cars, but those are products also that Tesla has yet to really commercialize in any fashion.
Watch this space. Craig, thank you, sir. Craig Trudeau of Bloomberg out of London. Let's stick with Tesla. George Gianarikas of Canaccord Genuity remaining bullish, writing, with momentum in near-term estimates, potential for new EVs, a continued expansion of the robotaxi, and the possibility of transformative developments in humanoid robotics, we reiterate our buy. George joins us now for more. George, welcome to the show. It's good to see you again. So let's talk about the quarter behind us. We're looking for that boom juiced by the expiry of tax credits. We had a lot of people come on the programme talking about how they'd been buying an EV before the interview even started, George. So I imagine we're going to see a lot of that. George, the question for you is, what does the rest of the year look like? What does early 26 look like? And how rough could this be?
I think you guys sort of nailed it in your previous discussion. In the near term, and maybe even the medium term, the issue is, can they continue the momentum? If you recall, the first 2 quarters of the year were pretty bad for Tesla, and there was a rush in Q3 to buy EVs in the US, but it wasn't only the US. I mean, they released some new vehicles in China that did incredibly well. So the question for people is, will we see a sequential decline in Q4, and it's normally an up sequential quarter, and what happens in 2026? The real question here is, what does the bridge look like? In other words, when can robotaxi, when can humanoid robots kick in such that they can continue the momentum in earnings for years to come?
What would you hear, George, that would make you think that maybe Tesla has to be valued as a car company and not necessarily as a company tied to self-driving and a host of other technologies?
That's a great question. And that's been a question for, 15 years. Tesla should be valued like a car company. Therefore, its earning multiple should be really low. And we should look at comps like Toyota and GM. But I was a tech analyst for over 15 years before I started covering Tesla. And really, this reminds me of companies like Alphabet, like Amazon, like Netflix. And that was the same debate. Shouldn't they be valued like advertising companies or media companies? And when you have companies that singularly disrupt end markets like Tesla does, it's really hard to apply the same valuation metrics to new companies. And so it's a debate that will continue going forward, but we look at Tesla as driving new innovations, driving new markets. And they're actually, what they've done in the last 15, 20 years is they created new markets. I mean, they've created essentially the EV market. They helped create the energy storage market. They're helping to create the robotaxi market, and they're helping to create the humanoid robotics market. So it's a different paradigm in the lens through which you have to look at Tesla.
I want to look at 2 aspects of that. On one hand, you've got the full self-driving, and on the other hand, you have the idea of humanoid robots. With the full self-driving vehicles, I'm just wondering how much Elon Musk was set back based on the frayed relationship that he has with President Trump. There was this theory that he would be in the front seat, not only technologically, but also in being able to roll out the robotaxi programs because of a sort of positive spin coming from the White House. Can you still lean on that? Is that still such a push that will help them get this through?
Those relationships are way above my pay grade, but I think it is essential for the United States to push forward on autonomy, AI, and the list of things that we need to do to compete more effectively against China. So in the medium to long term, despite the volatility in those relationships, I expect that the administration will push forward and help ease the path for us to be a leader in those markets and compete more effectively against China. So look, Tesla is one of the leaders in autonomy, and I continue to expect this deployment to accelerate over time.
George, do you expect they'll get squeezed out of a place like China? How difficult is it to compete there? It's a conversation we had with the GM CFO just yesterday. We've often called it the most competitive industry anywhere on the planet. It's got to be the Chinese EV market right now, George. Can they stick with it?
That's another really great question. I mean, Chinese EVs are remarkable, and they're the global leader in the space. And what Tesla has done really effectively is they've produced vehicles at a very low cost relative. They've done that on their own without really, over time, government support. And they have a feature set that's incredibly effective, and they've shown they're able to compete in China against these incredible companies in that country. So I continue to expect that they'll trade well in China, and that regardless of what happens politically, that to the extent they have a place to compete there, they'll retain market share. And they've shown that time and time again. People have counted them out in China numerous times, and they've just introduced new models with new feature sets that have effectively allowed them to maintain this share that they have for several years.
So, George, as you know, the big push now, technologically speaking, the development is all going into autonomous vehicles and robo-taxis. George, what is it about Tesla and the road it's chosen to go down, forgive the pun, and the road that Waymo's going down? Two different technologies. Why is one likely to be more successful than the other?
That's another really, really great question. So Tesla has effectively built a neural network, all AI and cameras to drive their vehicles, which allows them to have very quick scale, right? Because those vehicles are on the road already. Waymo has chosen to have multiple sensor sets and more of a hybrid solution to solving the problem. Some AI, a lot of AI, but also software coding and guardrails on top of it. That solution, that approach to market, doesn't let them scale as quickly as Tesla will. There are many, many skeptics around Tesla's approach just because it may not be the safest, and it may have some issues on the road, like with night driving or driving in inclement weather. And we'll see how effectively they can scale. There's a really good podcast last week from a guy named Andrej Karpathy who worked on the Tesla AI system. He was the head of Tesla AI. And he seems to think that both Waymo and Tesla continue to use a lot of network operators, people at network centers that basically effectively help them drive the vehicle. So we'll see how effectively Tesla can scale and how quickly they can wean off those network operators. But these are two very different approaches. One scales quickly and may not be as safe, frankly, and the other one scales slowly and is sort of bulletproof, so to speak, in terms of its safety. So we'll see which one wins the market, but they have two very different approaches. And over time, we expect robo-taxis to be wildly successful in the US and globally.
George, just real quick here. We just have about a minute. I'm just wondering, going forward, if you think we're going to be talking about humanoid robots for Tesla as much as we're talking about full self-driving.
Well, to a certain extent, we already are. And our questions around self-driving and humanoids are the same with regard to how quickly they can impact earnings. If you think about humanoids, there was another really good blog post. This is last week or 2 weeks ago. And this is from the founder of iRobot, who suggested that teaching robots dexterity might be much more difficult than Tesla and other companies think. So over the long term, humanoid should be a very big market, and Tesla, with its vertically integrated approach, should be wildly successful. But the question is timing. How quickly can they sell 1 million robots? I mean, Elon Musk is out there giving some timetables for that to happen. Sometimes he's not so good with his timetables, but he eventually gets the job done. Look, it's a market that we're very, very excited about. But again, it's a question of timing, how quickly they can impact earnings.
George, you're a gent. Thanks for joining us. Appreciate it. Some optimism around Tesla. George Gianarikas there of Canaccord Genuity. Up next on the programme, we'll catch up with Yelena Shulyatyeva of the Conference Board as we count you down to CPI data on Friday. Plus, Danny's back with your morning movers. GE Vernova climbing with big plans for powering AI. That stock is up by 3.9%. The opening bell about 60 minutes away, just getting confirmation from the US Trade Representative, Ambassador Jamieson Greer, that he and Secretary Scott Bessent of the Treasury will be leaving today for Malaysia to meet with Chinese negotiators. They were speaking to the press moments ago, saying China and the move on rare earths was, quote, aggressive. We've heard that from Secretary Bessent as well. That's where the negotiations are going to centre around over the next week. That and soybeans and a whole lot more. Equity futures on the S&P 500 at the moment going into the cash open just about positive. We have gone 3 days without gains, but the rally has kind of stalled in the last 24 hours. This market yesterday totally unchanged. With more, some movers into the morning opening bell. Let's get to Danny Berger for more. Hey, Danny.
Hey, John. It continues to be the big mover of the morning, and that is Netflix, and it is a move to the downside after putting their earnings after the bell yesterday. It was a tax charge in Brazil that spooked the investor base of over $300 million. They otherwise reported some solid results. Maybe it should have been better considering the popularity of things like K-pop Demon Hunter and a live sport event. Shares down just under 8% this morning. Elsewhere, you get that feeling of the meme stock mania. Beyond Meat up 77.9%. It is almost up 1,300% in the past 4 days. What's been driving it? There was a social media user who basically posted his thesis on why Beyond Meat should do well. That was apparently enough. You get a lot of short covering, and there you go. A big old move for Beyond Meat. Finally, some earnings back here in the real world. GE Vernovia reporting the huge demand they have. They're an energy company. You can guess where this is going. Their gas turbines, the hyperscalers, they say, are circling around them. To give you a sense of how things are growing, typically and historically, 10% of their business has been hyperscalers. A third of their orders going forward are now coming from hyperscalers. So it is moving in that direction with this huge energy demand. Shares up 4.2%, John.
Some of these stories used to be defensive. Utilities, defensive. Not anymore. It's just the tech trade all over. Danny, thank you. Thank you.
And when you talk about people with the tech trade, their angle in is diversification, which means look for other energy companies that maybe haven't been bid up as much. So you're right. Are they defensive, or maybe they have a very different characteristic at this point?
Fantastic profile over the weekend of Barron's of Constellation Energy and its CEO. That stock year today up by about 60%. We'll leave that story there. Let's stick with earnings. Shares of Mattel taking a hit as retailers delay orders over tariff uncertainty. Bloomberg's Enda Curran joins us now for more. Enda, we're starting to see it. Might not be a big stock market issue, but a company turning around and saying some retailers are holding back, waiting for clarity. How much of an economic issue might that be?
Well, it's a big question, a big missing piece of the jigsaw. When will these tariffs start to flow through to more broadly goods on the shelf, Jonathan? And, this warning from Mattel, on the one hand, that tariffs are impacting its delivery of its goods, reflects what a lot of companies tell us all the time, that they've managed this process up to now. Either they have absorbed the tariffs or they've asked their suppliers to absorb the tariffs. But at some point, that part of the equation will have to give, and they will pass those costs on to the consumer. That's the big question over the coming months. Now, to be clear, we haven't yet seen broad-based inflation from tariffs, and even Mattel made the point that consumer demand remains resilient. We saw lots of other consumer brands doing well also in this earnings season, Coca-Cola and GM and the like. So clearly there's strength out there, but this question mark about when the tariffs will eventually hit home remains an open one, I think, for economists.
And it's an open question as to whether the Fed will respond to it or should respond to it. And based on what we've heard from Chairman Powell, he's setting up this whole market just to ignore it. It's kind of bizarre that we've got no data right now, Enda. And even the data we do have, the market's prepared to ignore inflation, CPI on Friday. The amount of notes that I've read that have basically said it doesn't matter what that inflation number looks like on Friday, this Fed cuts a week today. And do you and the team see it the same way?
We are in a bizarre space, Jonathan. That's the only way to describe it. Look, if you were to just go face value with the data that we had up to the lockdown and maybe some of those private indicators up to now, you could say it suggests the labour market remains soft, but the inflation story hasn't gone away. The Fed will carry on with their cut in October. That's been all of their public utterances. But really after that, it becomes a much more complicated story, Jonathan, to your point. What happens if we get the data back on tap, and it does suggest that the labour market maybe is so-so, if not softening, but inflation remains persistent. We know there are plenty of officials on the Fed board who have concerns about inflation. So, that cut next week in this month of October seems a lock. But in the months ahead, it's probably going to be a much more complicated story.
Enda, thank you. Enda Curran down in Washington, D.C. Sticking with tariffs, Yelena Shulyatyeva of the Conference Board writing the following. U.S. real GDP growth is projected to slow to around 1.5% next year as higher tariffs raise consumer prices and dampen spending. Yelena, good morning.
Good morning.
1.5% is below where the Fed is.
Well, yes. And I think the reason we are expecting such a slowdown is that because we think we have not seen the full impact of tariffs just yet. Companies may be adjusting to the ways tariffs operate and they're shifting some sales and inventory accumulation. But the problem is that consumers have not fully seen it. And that is all happening against the backdrop of higher healthcare costs, rising insurance costs, and things that we don't really necessarily talk about in everyday life. But it's just an add-on to rising costs for the consumer. And I think that will weaken GDP growth more than probably we'll see the inflationary impacts.
I'm having this sort of emotional yin and yang. On one hand, we've got investment managers who come on set and they talk about how everything is awesome, it's Goldilocks, and that they actually see disinflation coming down the pike from rent and from other aspects of the CPI and the core PCE. And then economists come on and they say, actually, growth isn't that great and inflation's going to pick up. Why is it that there is such dissonance right now?
So we look into intelligence we collect from companies as well. So at the conference board, we have the CEO confidence survey. And the latest survey showed companies are still kind of on the edge. Like they are, well, maybe we're not going to grow that much, but we are not that concerned either. So what's interesting in the survey is that companies are concerned about the outlook. So that has worsened a little bit in the survey, but they are more confident about the outlook for their own industries. So what it tells us is that companies are adjusting to the new reality with tariffs. So the tariff shock is probably behind the initial psychological shock. But the impact for the consumers, I think, is still ahead of us. And the holiday season will be a major test.
So this is something that even the retailers are saying, and Mattel is saying that their orders are reaccelerating in the fourth quarter. We hear from a lot of investment managers as well as CEOs that there does seem to be this reacceleration. What would you have to see to say maybe I'm wrong? Maybe that some of these surveys aren't indicating the reality, which is something a lot more positive.
Absolutely. I think we have seen that consumers have been very resilient this year, and that totally surprised to the upside. That surprised our projections for slower and quicker deceleration. I think the holiday season is the major test to consumer tolerance. We passed that into Q1, and if consumers are still resilient, that would be a big thing for me to consider revisions.
When you look at how much these companies are absorbing tariffs, what is the paper tariff level, and then what are they actually paying?
Absolutely. So if you just look at some kind of an average on the paper, it's like around 20%, roughly speaking. But if look at duty collections and compare it to imports, it's around 11%. So that kind of tells you maybe there's more to come. And companies did all this shifting for the supply chains and things like that. And maybe there's more to come. And it all depends on what happens to tariffs next. We haven't settled on that one.
No, we haven't. And potentially we're going to get a big meeting between the two biggest economies. Another issue a lot of CEOs talked about in your survey was AI.
Absolutely.
And what that means for job growth. They think it is going to change how they hire, but they're not seeing it yet. When will they actually start to change how they recruit and hire?
So it's a major big thing for all companies. They all mentioned that, and a lot of them saying that it will change the way we hire. But they don't see that happening. Like the majority of them don't see that happening until after 2 years. So 3 to 5 year horizon. So we're in that moment where we see downside risks to the economy, but maybe over the longer run, that's what happens. AI is a big deal, and it's everywhere. Everybody's talking about it. Everybody's seeing productivity driving growth going forward.
How do you think the Fed's going to handle this moment? And is its dual mandate fit for purpose?
Absolutely.
When you think about the future of growth, I mean, let's just play it out. You could have a situation, at least in the near term, where it's high energy intensive and low labor intensive growth. How problematic is that for a Federal Reserve with a dual mandate of full employment and a price target of 2%?
Well, they have to raise it implicitly or explicitly. But again, there are so many unknowns in the short run, including the new Fed chair and things like that. So it's a tough situation for the Fed at the moment. And I think the risks to the labor market are still real in the near term.
That's certainly what they're prioritizing, that's for sure. Yelena, good to see you, as always. Yelena Shulyatyeva there of the conference board. We had this conversation with Governor Waller last week, at least briefly. He was like, this is the dual mandate I've got, this is what I've got to follow. I just wonder if that's going to be up for debate in the next few years. If the dynamics behind what drives growth, what's behind it, how energy intensive it's going to be, what it could mean for payrolls, for jobs, whether they're going to have to change the way they think about things.
You could argue it already has affected the way that they think about things. And you could say that that really began after 2008 and the scarring that happened with the labor market, that there has been a real prioritization of the labor market over price stability. And you could argue that is the reason why this Fed has been complacent with the idea of letting inflation remain so far above its target for so long at the expense of at least trying to protect the labor market.
AI this morning is bringing together unlikely bedfellows. Steve Bannon, Prince Harry signing up to the same statement regarding superintelligence of AI and what that can mean for humanity. long term, what you're talking about in 3 years, that's right around the presidential election. There's going to have huge political implications.
Yeah, massively. And it could be for the midterms already, by the way, with the energy story picking up across this country. Equity futures on the S&P just about unchanged. In about 50 minutes' time, we'll get the opening bell into that. Stocks going nowhere. With an update on stories worldwide with your Bloomberg brief, let's cross over to Yahira for more. Hey, Yahira.
Hi, John. The Federal Reserve has shown other regulators revised plans to relax a bank capital proposal for Wall Street, and it's lower than previous estimates that were floated. Sources telling us here at Bloomberg, some officials have calculated the terms would lead to an increase of about 3 to 7% in aggregate for most big banks. The Fed's new plan could be unveiled as soon as the first quarter of 2026. Meanwhile, Apple's iPhone Air is off to a slow start in China. Its launch drew curiosity, but no big crowds, which is in stark contrast to the iPhone 17 rollout. Meanwhile, Nikkei is also reporting that Apple is drastically cutting iPhone Air production orders and boosting those for other iPhone 17 models. And the NBA season tipped off last night and delivering a thrilling opening night doubleheader. The NBA champion Oklahoma City Thunder defeated the Houston Rockets in a double overtime thriller, 125-124, led by a clutch performance by reigning MVP Shai Gilgeous-Alexander. Elsewhere, the Golden State Warriors defeated the Lakers 119-109 behind 31 points from Jimmy Butler. That's your Bloomberg Brief. John?
Product sucks, zero interest. That's how I feel about basketball every single time.
I know, I can feel it.
It peaked in the 90s and never made a comeback.
You know, we had a discussion about basketball last night. People in the household enjoyed it. They were arguing about what's a sport and what's not a sport, and the idea that basketball is very much a sport. There was debate on golf.
Okay.
There was debate on some of the other things and sort of a question around peak age. And if you can be 45 and still at your peak, is that really a sport?
I used to think about that for golf, and then I played. And I was like, okay.
You walked 18?
Yeah, totally.
Not only that, like the way you hit it,
sure,
all the movement in your legs, it actually, but you know, it's hard. And then I was like, okay, now I agree this is a sport.
I couldn't do the Rory McIlroy workout. You ever seen that?
No.
Yeah, that's intense stuff. I couldn't do that.
Honestly, the fact that this was a discussion, not what is your basketball team, tells you everything.
Exactly,
you need to
they're not engaging.
Yeah, exactly.
Right, there you go.
True.
Up next on the programme, setting you up for the day ahead, plus Christian Mueller-Glissmann at Goldman Sachs with more on this market from New York City. You're watching Bloomberg TV.
We're actually very bullish heading into next year. I know the day-to-day noise around uncertainty is high, but I think all of that starts to come down, and you look through that out in the next 2 to 4 years. I think America does really well in the next couple of years.
That's the positive, constructive call from Darrell Cronk of Wells Fargo. As we count down to the opening bell, your scores look like this. Equity futures on the S&P 500 drifting just a little bit higher, positive by 0.1%. I was so harsh on the NBA, I'm sorry. It's great to see it back on NBC. Bit of nostalgia,
No.
I get all of that.
You can't put that back in the bottle.
Got to try and bottle it back up. It's brutal.
Jimmy Berlin's excited, I'm sure.
Just towards the end of the show, you get a bit,
You get a little punchy and start being too honest.
Just a little bit too much.
This is for you.
A Knicks mug?
A Knicks mug, yeah.
All right, okay. Expensive to go and watch that, isn't it?
Okay, all right.
It's unbelievable.
But not as bad as help yourself.
It comes right back out again. I can't. Plus, going over to Madison Square Garden, no thank you.
Oh my God.
The worst.
No, hold on. We've been to a Knicks game together.
We've been to a Knicks game
so much
together.
fun.
It's a lot of fun. It's also very expensive, and it's a horrible area. Okay?
All right, I agree on all points.
All right, okay, good. Okay, let's get back to the market. Christian Mueller-Glissmann of Goldman Sachs. I tried. Just just inauthentic.
Absolutely, just crashed.
This is what Christian's got to say. Outside of the US, investor allocations to equities are generally lower, but in most markets they have also increased. Notably, aggregate equity allocations now surpass peaks from the late 1990s. I'm pleased to say that Christian's actually with us in the studio. Christian, good morning. It's good to see you, sir. You put out a note recently, a big paper, investing in everything, everywhere, all at once. Can you share us with what you and the team found looking at that?
Yeah, I mean, listen, I think we tried this kind of experiment of trying to map literally every asset that exists in the world. We found like roughly 270 trillion, and we tried to understand on the one hand, what can you actually get in terms of performance by literally just buying everything, which is already interesting. And we found it's quite easy to outperform that portfolio, actually. But also within that portfolio, you get some very interesting concentrations, asset bubbles over time, because we go back to World War II. And it shows you also it's a major influence on investor asset allocations. You mentioned it just, like the fact that equities since the global financial crisis have done really, really well, especially in the US, has meant that literally everywhere in the world, equity allocations have moved up a lot. In the US, it's most extreme, where you actually, despite the fact that the equity weight in the world portfolio is not at tech bubble levels, investor allocations are actually at tech bubble levels. So they're a bit ahead, you could say.
This raises lots of questions. Now, typically, we talk about a 60-40. What's the share of equities, bonds in that? Everything, everywhere, all at once. And how are alts starting to participate and grow as a portion of the share?
Yeah, I mean, listen, I think if you look at the weight right now, it's 50%. So it's a bit smaller than the 60-40. But if you look in the tech bubble peak, you were at 63. If you look in the 60s Nifty 50 bubble, you were at 60. So, you know, this is actually quite an interesting statistic to tell you that maybe we're not in a bubble yet. As a proportion of financial assets, equities are not as extreme as they were in previous equity bubbles. So from that perspective, it's gone up a lot, the weight. It's pushed kind of the equity allocations of investors up a lot, but it doesn't look as extreme.
All I can say is you could make an argument if you have more extreme valuations and more extreme allocations to equities, that would be bearish. Most people have come on and said, actually, that's bullish because it's not fully at the bubble level, and you might as well ride the bubble train as long as it keeps bubbling. Is that kind of where you are, too?
Well, the way I would put it is like, the current backdrop, the late cycle backdrop with a lot of policy easing, as you were discussing earlier, the labor market is very weak, but the corporate sector is strong. We've seen it before. You actually had similarities in the late 90s, where you also had the Asian financial crisis at the time, forced the Fed to cut into a late cycle backdrop with the technology revolution, which ended up in a tech bubble. And in the mid-60s, you had the Great Society program coming after the Vietnam War, a lot of fiscal easing into a kind of like stability bubble, like the Nifty 50 bubble, driving up valuations. So I don't think it's completely crazy to see equities being very well supported right now by the macro. It's an uncomfortable backdrop because it's not the usual type of growth goes up without inflation, everything is fine, let's buy equities. It's much more driven by liquidity, and it's much more driven by structural themes like AI and fiscal debasement. And both of those themes are actually quite good for equities. So I would say at this point, we are not necessarily worried about the investor asset allocations. We are in the medium term worried. The same with valuations. A lot of these metrics, they mean revert in the very long run. But in the very short term, we're not necessarily worried because of that.
The idea of debasement being good for equities, particularly in the United States, might be true if you are dollar denominated. Less true if you are coming from Europe. And I do wonder how difficult it is for European investors to invest in the U.S., whether they want to invest in the U.S., whether they decide to hedge. I mean, have we seen that Europe-U.S. trade reverse? Because earlier it was sell the U.S. and now it's maybe not.
I think it's a good point. I think after Liberation Day, there was this very short-term repatriation where European investors actually sold US equities and bought domestic equities. That has completely reversed. Since the summer, we actually see more inflows into US equities. And what we're discussing with asset owners is really a bit like with the total portfolio approach, which kind of more and more comes into the investing scene in the asset owner space, is you got to ask yourself, what are the long-term structural exposures you want? And we always say you want to have a combination of exposure to innovation and protection from inflation, which includes the debasement. And innovation, the US and China and a few places in the world, they just have the best companies. They have the liquidity, they have the access. And you can't really find that domestically. So you go where you can domestically for protecting inflation, for finding debasement, for finding interesting long-term kind of stories for cash flow growth, real cash flow growth. But the innovation you have to get in places like the US.
How different are the conversations on either side of the Atlantic?
I think broadly one similarity we have is people are quite cautious. And I think that's so interesting with the equity markets having done so well. We don't really see that in our conversations. We don't really see that in our sentiment and positioning metrics. The institutional community, which are mainly investors I speak to, they are cautious. They're cautious about the labor market, of course. They're skeptical and worried about the AI ecosystem and similarities to previous bubbles, exactly what you said. The main difference, I guess, is that everybody always seems to be a bit more bearish, I noticed, on where they are. That is really weird, but I really noticed that, like when you go to Italy, to France, when you go to even the US here, since I've been here, like people generally are quite worried about their domestic political situations. People are a bit more cynical about like the long run outlook for their countries. So like the Europeans, they look a lot to the US at things being much better here because you have the innovation, you have the wealth effects, you have a lot of things going right. But when you meet the US investors here, there's still a lot of concerns.
There is a disconnect, and there's an obvious one. If you look at the European growth story right now, it's pretty awful. It's not great. The ECB's forecasting 1% and everyone's saying success. 1% growth. And I think that you look at the growth profile of Europe right now and compare it to the massive outperformance we've seen in Eurozone banks, trying to work out what gives here into next year.
Yeah. I mean, it's coming back a bit to what banks are. Banks are carry trade. Like they're making money when things are good in terms of net interest margin. They don't really need growth. Growth is an upside story, which I think we haven't had in Europe a long time. So growth hasn't really driven banks in a big way. So it's a carry trade, and the current backdrop is very conducive for carry trades. And to me, I think the European story next year with the German fiscal spend might look a bit more growthy. There might be a bit more reflation. And everybody I speak to is incredibly cynical and skeptical about that. Everybody says, yeah, Germany committed to a lot of fiscal spend, but they probably won't manage to deploy it. There will be bureaucracy. It will not come down. And our economists have actually been saying that probably already this year, because Germany publishes the fiscal kind of spend every month, there will be the first upside surprises. So investors, I think, are not positioned for that.
What's growthy in Europe?
Well, I mean, you have obviously specific areas like linked to fiscal spending, fiscal infrastructure, defense. These are areas that are often mentioned. I think the big story to me is if you go a bit more reflationary, savings rates in Europe since COVID have been much, much higher and actually not come down at all. So, you don't have the wealth effects like in the US, but there is savings. There is a lot of liquidity that's being trapped. And liquidity often follows confidence. So if you get a bit more of a reflationary shift driven by a few industries, might be fiscally driven, that possibly drives a bit more consumer reflation.
Get the regulators to get out of the way and things can improve. Christian, it's good to see you. Thanks for sharing your thoughts. Really thoughtful stuff. Christian Mueller-Glissman there of Goldman Sachs. Coming up tomorrow, here's your lineup. Cameron Dawson of New Edge Wealth, Dan Ives of Wedbush, the former Boston Fed President Eric Rosengren, and Liz Thomas of SoFi. From New York City this morning, good morning to you all. This was Bloomberg Surveillance.